To think that we could slip into a soft landing or a potentially harder landing is not unreasonable.
We look at it as a soft landing as we're already in the midst of it.
The problem with soft landing is it sort of would suggest that things have stopped.
It might not be landing at all and actually seeing the plane turning back up.
The economy is fundamentally sound, so it can absorb shocks.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your trading day started live from New York City this morning. Good morning for our audience worldwide. Your scores look like this on the S&P 500. Equity futures backing away after a 1% gain in yesterday's session. We're down 0.1%. On the Nasdaq 100, we're down by 0.2%. The next 24 hours shaping up as follows. CPI tomorrow morning at 8:30 Eastern Time. Later on this afternoon, the Fed speak from the Fed minutes from the last meeting. Look out for that at 2 p.m. Eastern Time. We start this morning, though, with a single name. It's Alphabet. Google in the pre-market negative by 1.2%. The DOJ knocking on Google's door.
And we already knew this, right? Bloomberg actually reported this was going to happen, but now we actually have the filing from the DOJ. And what it talks about is Google's anti-competitive conduct resulted in interlocking and pernicious harms. This is what the DOJ is talking about. What I think is so different now, when everyone's going to talk about Microsoft, is the politics. Remember, it was the Trump administration which first went after Google, and now it's the Biden administration that's inheriting it and looking for a potential breakup.
But what a lot of people miss in the Microsoft example of 2000, they say, look, maybe the worst will be avoided because it was avoided for Microsoft. They didn't break them up. It still scared Microsoft enough where they didn't make certain acquisitions. They held off on certain things, and it allowed up-and-comers like Google at the time to really shine. So even if they don't break them up, there are still consequences to be had.
A lot hanging over this stock through the year so far. Not just this story, but AI as well. And yet here we are still up year to date by close to 18% on Alphabet through the close yesterday. The quote from the DOJ pretty scathing, considering behavioral and structural remedies that would prevent Google from using products such as Chrome, Play, and Android to advantage Google Search and Google Search-related products and features.
Yes, so two potential outcomes, the remedies that we could see is putting an end to these exclusive agreements Google has with things like Apple, with Samsung, also prohibiting certain kinds of data tracking. And then, Danny, you make a great point when it comes to things like AI. Potentially Google will end up, even just by their own nature, because what they're seeing out of Washington, pull back on the sidelines of some of these agreements they're walking into.
It's one to watch this morning. Google's down by 1.2% in the pre-market. One to watch this evening. Hurricane Milton set to make landfall in Tampa. Across Florida on the West Coast, this is going to be a big issue for the state and maybe for the economic data for this program for months to come.
It's already a fog amongst the data. It's already confusing to figure out. Then you add in not just this hurricane, the hurricane before it too. It's a lot of factors to consider. And not just that, it is the human life. 5.5 million people being told to evacuate, the largest in the state. Just the logistics of that alone, save for the damage of the hurricane, is already complicating things.
In Irma in 2017, it was nearly 7 million people leaving their homes. This could potentially be bigger than that in terms of people getting on the roads. The roads are now clogged. Also interesting, Patrick DeHaan of Gas Buddy today put out saying that more than 1 in 5 gas stations in Florida are out of gas. So you can already see people are struggling to get the basic needs, even just to leave their homes right now.
We'll bring you updates throughout this morning, including this one from Alex DiSilva of AccuWeather. He'll be joining us in about 10-15 minutes time. Equity futures on the S&P 500 then doing okay. Equity futures just a little bit softer on the S&P 500 following a solid day of gains. We're down 0.1%. In the bond market, yields are higher by a single basis point. The 10-year holding on to 4.02% on a 10-year yield. Coming up this hour, we'll catch up with Andrew Sheets of Morgan Stanley on the path to a soft landing. We'll speak to Adam Kamins of Moody's Analytics on the economic impact of Hurricane Milton, and Rob Hocking of CBOE expecting volatility this election season. We begin this hour with stocks edging lower as the DOJ considers a breakup of Google. Investors looking ahead to CPI tomorrow for clues on the health of the US economy. Andrew Sheets of Morgan Stanley in the soft landing camp. Soft landings don't have to play out in a straight line. This is a tricky window where risks around growth are skewed to the downside. A few false negatives in the data can lead to bouts of volatility. Andrew joins us now for more. Andrew, welcome to the program. Let's start with that phrase, soft landing. What does it mean to you?
Good morning. It's great to be here. So for us, it means inflation coming down, the Fed easing, and no recession. And that's, very much what Morgan Stanley has been forecasting what we continue to forecast. And I think that's what fortunately, we've been seeing from the data. I think we were in a critical window over September and still in October where the market's going to be more vulnerable to weaker data because the Fed and the ECB haven't really gotten underway yet with rate cuts. But I think so far that data's come in pretty solid, and I think that supports the soft landing view.
Andrew, you referred to some of the data as a few false negatives, potentially in our future. Can we talk about the data we had through the summer and at the other side? Which one was the head fake, the deceleration in jobs through the summer or the reacceleration we saw on Friday?
Yeah, so I think it was potentially this kind of rise in the unemployment rate. And this has been something that's in a lot of focus because, over a long period of time, it's consistently been one of the more worrying cyclical indicators for markets. Once the unemployment rate is rising, it's almost kind of too late. At that point, that's one of the last indicators historically to crack. And at that point, it's very bad for equities and credit. And I think that's what the market was concerned about. You had concerns about triggering the Somm rule. You had concerns that the unemployment rate was already going up. And yet the Fed, as of the July meeting, had still kept rates on hold. Now, there was another view there, and that was the view closer to the view of Morgan Stanley's economists, which is that the unemployment rate was giving somewhat potentially kind of misleading signals because of the shape of the labor market, the fact that participation was actually quite strong. That was kind of confounding the picture a bit, but we really didn't know. And even heading into the other week with the latest non-farm payroll number, you had a really wide set of expectations going into that number, an unusually wide set. So I think the number we got was good. We were at 160,000 at Morgan Stanley. We got a better number than that. And also, I think, given some of these very kind of unfortunate and tragic natural disasters that we're seeing in the U.S., that could make the next several data prints more uncertain. So I think the fact that we got one solid reading for the economy or another solid reading on jobs is quite helpful for, I think, assuring the market that for now the economy is still in an okay place.
Even with those prints, it's interesting to look, Andrew, at how Fed language hasn't changed. They are still talking about a balanced approach. Balanced is the new buzzword. Collins said it yesterday. Jefferson said it too. And we have an Atlanta GDP Now tracker at 3.2%. If it is a Fed that is still biased to cut with a strong economy, how positive is that for risk assets?
Yeah, so we do think we're still in a good is good environment. You mentioned correctly, we also follow that Atlanta Fed tracker. We think it's been a great indicator recently, and it is suggesting a very strong U.S. economy. But I think the other important thing is inflation is really looking like it's getting back under control, that kind of the battle against inflation has been won. And if you look at forward-looking inflation expectations from the interest rate market, say over the next 2 years, those are kind of below. Those are implying a number below what the Fed is targeting. So if we think about kind of historical performance patterns, certainly historical patterns for credit, a scenario where the economy is holding up better, where the Fed is cutting more gradually towards neutral, which is, what we're forecasting at Morgan Stanley. We think from this point on, they're doing 25 basis point cuts. That's been a much better kind of trade-off for risky assets than one where growth is weakening more and you're getting a lot more Fed cuts. So I think the scenario that we're getting in the data is very much tracking closer to that better soft landing base case.
That scenario you lay out, it's happening in the Treasury market. That repricing has happened since Friday. But Andrew, in the corporate credit market, the repricing hasn't happened. Investment grade spreads are still at 83 basis points, exactly where they were on Friday. Are you surprised by the resilience, the unmovedness of this market?
Well, look, spreads are tight, but our view at Morgan Stanley has been that spreads should be tight, that we're in an environment of better than expected fundamentals. We think a soft landing is an unusually good backdrop for credit. Credit likes moderation. A soft landing is all about moderation and growth and inflation and monetary policy. And you still have very good technicals. You still have very strong demand relative to supply in the market, and better than average fundamentals, better than average technicals probably should mean, tighter than average, richer than average valuations. So I think another important factor, and I'm glad you linked it to yields, is we do think we're in an environment where higher yields are good for spreads, that higher yields are bringing in more demand from insurers, from pension funds, from a lot of the buyers who've been really driving the market over the last year. And so, with yields going up to 4%, all of a sudden that same spread, hits a lot more yield bogeys for those buyers.
Andrew, right now we're dealing in an environment where there's a number of potential risks. In the United States, there's the politics. Potentially, we're not going to know for days, weeks, or we could see a contested election. Then there's the geopolitics. We've seen the short-term increase in the oil price. What is the biggest catalyst to potentially your soft landing scenario?
Well, I do think, understandably, I think the U.S. election is going to and will get a lot of that focus. So, I think you are facing a close election. That's one important factor. And between two candidates with very, very different policy agendas and policy proposals. And so, I think in terms of thinking about factors that are not just going to affect the market over the next month, and we are, less than a month away from the U.S. election, but also really going to potentially affect how investors think about pricing into next year. I do think the U.S. election probably stands out as a really important factor. And that's why certainly, at Morgan Stanley, we've been devoting a lot of our effort to trying to understand the issues around it and research related to election implications.
Do you think the market right now is properly hedged for a scenario where the election might be contested?
Well, I think it's difficult to say. I mean, I think we have seen some increase in volatility around the month of November, but it's also a factor where this is an issue. I mean, I'll talk about the election more generally. That is a kind of a known unknown heading into next month. The markets had this on their calendar for a long period of time. I think a lot of investors in our meetings cite the election as a major source of uncertainty. So, I do think as much as it's fair to say that the election is bringing up the potential for volatility, is bringing the potential for uncertainty, I think it's also possible, it's also fair to say that investors are very aware of this and that they're going in with their eyes open. Now, again, I think it's a factor that we also, when we look out into 2025 and again, we're pretty optimistic, say, on more M&A activity in the market. We actually think that moving past the election, just kind of having this, once this question is resolved, that can be a positive catalyst in certain ways, that can help, we think, trigger more corporate activity, and that there are some, some risks associated with it, but also some positives as you move past the event.
You're not the only one who said that. Andrew, appreciate it. Andrew Sheets there of Morgan Stanley. Your equity market on the S&P 500, just a little bit low. We're down 0.1% with an update on stories elsewhere. With your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Millions in Florida are bracing for a potentially catastrophic hit from Hurricane Milton, which is approaching the state's west coast as a dangerous Category 5 storm. Milton is expected to make landfall later today, bringing damaging winds, heavy rainfall, and a life-threatening storm surge. This will be the second major hurricane to strike Florida in less than 2 weeks. Meanwhile, the Justice Department is considering breaking up Google. It comes after a judge found in August the company had broken antitrust laws to ensure its dominance of online searches. In a court filing, the DOJ said, quote, "For more than a decade, Google has controlled the most popular distribution channels, leaving rivals with little to no incentives to compete for users." The judge could also order Google to provide access to the data it uses to build its search results and artificial intelligence products. Google has already said it will appeal the ruling. And the Kremlin confirmed that former President Donald Trump sent Russian President Vladimir Putin COVID-19 tests during the height of the pandemic. The claims were first reported in a new book by Bob Woodward, in which he also said the two leaders had spoken by phone several times since Trump left office. The Kremlin denied that claim. That's your Bloomberg Brief. John.
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, Florida prepping for the storm of the century.
The current path of the storm affected the Tampa Bay area and cut directly across the state, east to west, all the way across the state. This could be the worst storm hit Florida in over a century. And God willing, it won't be, but that's what it's looking like right now.
That conversation just around the corner, live from New York City this morning. Good morning. The latest news from Citi. Good news is still good news. Your equity market on the S&P 500 just a little bit softer. We're down 0.1% on the S&P 500. Still Goldilocks over at UBS. Mark Hayfully. The US data is not so strong that the Federal Reserve's contribution to the global rate cutting cycle looks set to end. Still, we hold on to a 4 handle on a 10-year. Yields just a little bit higher again, 4.0178%. Under surveillance this morning, Florida prepping for the storm of the century.
The current path of the storm affected the Tampa Bay area and cut directly across the state, east to west, all the way across the state, with the potential for this storm to both enter Florida as a hurricane and leave Florida as a hurricane on the Atlantic coast. This could be the worst storm to hit Florida in over a century. And God willing, it won't be, but that's what it's looking like right now.
So here's the latest this morning. Florida bracing for Hurricane Milton, a dangerous Category 5 storm expected to make landfall later tonight. Forecasters anticipating the storm will deal a serious blow to the Tampa Bay area less than 2 weeks after Hurricane Helene hit the state's west coast. Joining us now is AccuWeather's Alex DiSilva. Alex, you've been tracking this one for days. How are things shaping up?
Yeah, well, we've seen the storm explode here over the last 24 or so hours, getting back up to Category 5 status as it closes in on the Tampa Bay area. We're calling for it to be a Category 4 hurricane, very dangerous hurricane, as it makes landfall from the mouth of the Tampa Bay down to around the Sarasota area. So small wobbles can make a big, big difference. The main concern I have is going to be the storm surge. It could be catastrophic, especially around the Tampa Bay area, down south to around Venice, where we could see as much as 15 to 20 feet of storm surge just south of where the storm makes landfall.
Alex, when exactly will the storm make landfall, and is there a chance that it can weaken ahead of time?
Yeah, we are expecting the storm to lose a little bit of wind intensity as it moves to the north due to the fact that it's going to be interacting with a little bit more wind shear across the northern Gulf Coast. We are forecasting landfall to be 2 a.m. Thursday morning Eastern time, right around the mouth of the Tampa Bay.
Alex, we've heard from the mayor of Tampa saying if you choose to stay in one of these evacuation areas, you will die. Can you just underscore the historic nature of this, how different this hurricane is to past ones Florida has experienced?
Yeah, well, it's going to be extremely dangerous. And the mayor was pointing out that the storm surge is being the primary concern here. The storm is going to be coming in from the southeast like this, and it's going to be shoving all of the water into all of these little bays and inlets. And it's a very flat continental shelf, which is more prone to storm surge. So you're just going to be pushing all of that water into these bays, and it's going to be trapped in there. So you could have multiple high tide cycles of storm surge coming in, and then since we had Helene, a lot of these bays and inlets, the barrier islands, have been significantly weakened by Helene. So a lot of the sand dunes and things like that have been weakened. And so this area is much, much more prone to storm surge.
Alex, appreciate the update. It looks absolutely brutal. Alex DiSilva there of AccuWeather on the latest with Hurricane Milton. Let's head over to the nation's capital. Katie Light standing by, Bloomberg's very own. Katie, let's cut to the chase. There has been an attempt, I think, on the campaign trail to make this a political issue. Yet when you hear from President Biden and Governor Ron DeSantis of Florida, it doesn't look like there's a problem between the two in any way, shape or form.
Between the president and Ron DeSantis right now, John, sure. Between the Vice President and Ron DeSantis, perhaps a bit more so, as there's been accusations that she was trying to politicize the situation by making a phone call to Ron DeSantis. He later said he wasn't aware that phone call was made, but said she really has nothing to do with this. So it is being factored into this presidential campaign, not just when it comes to Kamala Harris and her role in this, as she potentially could have the power here to look presidential, to express empathy to people, but also if there's any weaknesses in the federal response and people are unhappy with it, that because she is associated with this administration could backfire on her. Then there's the Donald Trump factor as well, when we're thinking about how he may be politicizing this, as he has been spreading mis and disinformation about hurricane response, falsely claiming that FEMA's only providing $750 to those who lost their homes, falsely claiming that $1 billion in FEMA money was sent to migrants instead and now has gone missing, making false claims about the rescue efforts as well. So much so that even a Republican congressman from North Carolina, Chuck Edwards, had to put out a statement yesterday debunking some of these online rumors and misinformation, including saying no one can control the weather, because, yes, that is something that some Republican members of Congress has been suggesting is happening here. FEMA has a rumor response page up on their website now. And of course, we heard the president yesterday speaking from the White House saying that this kind of misinformation is making people fear that the government is not going to be there to help them when they are.
And when it comes to Florida, I spoke to Governor DeSantis' team before Biden came out, and they had said President Biden, the governor, had a great conversation, and Biden gave him his personal line, which Biden then confirmed to the press. So when it comes to all of this, let's cut to the chase. Is FEMA, is the Biden administration doing its job and getting these states everything they need right now?
To this point, Anne-Marie, there has been no major complaints from those leading these states in the recovery efforts that FEMA has had major shortfalls. Obviously, no rescue effort and recovery effort is going to be perfect. There has been some condemnation of certain delays in arrival times in Western North Carolina, for example. But by and large, the resources have been there. And despite concerns over funding that FEMA may have, resources that they may not have to offer, the Homeland Security Secretary Alejandro Mayorkas said they do have the money and resources to meet the immediate needs of this storm, including having tens of millions of meals ready and water ready to go. And of course, already 900 personnel surged preemptively to Florida as they deal with the aftermath of Hurricane Helene that hit just 13 days ago, and now are preparing for Hurricane Milton. Longer term, though, there is going to be a question of the economic toll of this storm. Combined with Helene could be hundreds of billions of dollars. And that longer term funding is a very different conversation, one that is likely going to need to be addressed by Congress with a supplemental, though the House Speaker, Mike Johnson, has said there's no rush for them to return here in Washington to vote on that.
Congress has a really long to-do list when they come back into session, certainly in December. Kayleigh, how can this impact November 5th and people's ability to vote?
Well, that's a major question, Anne-Marie. As we are talking about potentially 15 feet of catastrophic storm surge, major damage could be done to infrastructure, as we already have seen in Western North Carolina, where roadways and transitways have been majorly damaged. And even the Transportation Secretary, Pete Buttigieg, when we spoke to him last week, said it could take a long time for that to normalize. So it does raise concerns about the ability for people to get to a polling place or to be able to mail a ballot in for those absentee ballots to actually work their way through the system. So it could have a major factor here when it comes to turnout. The other question, of course, is how it may impact voter sentiment in these affected areas, not just when it comes to the presidential race, but races down the ballot as well. I was speaking with some people yesterday who noted Senator Rick Scott in Florida, which is an area where Democrats are eyeing what could be a long shot but potential pickup opportunity of his Senate seat, does have a long history of being able to respond to disasters, as he was the former governor of that state. He, of course, showed up with President Biden when Biden visited Florida last week in the aftermath of Helene, and this could potentially be something that actually helps him in his race. So there's a lot of political implications to consider here, though, but actually allowing people the ability to vote, making sure they have what they need to exercise their role in the democratic process is going to be a major one.
Kayleigh, does it change the tone just globally of candidates' ability to campaign when there are natural disasters and concerns and using aggressive language otherwise and other issues? Does this mean it's time to pull back, considering the national dialogue?
Well, rhetoric, Danny, I guess we'll see. We haven't necessarily seen that historically when it comes to at least one of these candidates, but it could change the nature of the campaign in these final weeks leading up to the election. We saw last week that the candidates diverted their plans to be there to respond to Helene, to visit some of the affected areas. Kamala Harris cutting short a western swing, for example, returning to Washington. Donald Trump traveling to Georgia as soon as he could. So this could potentially focus the campaigns instead on Florida, or reduce the actual campaign activity out of respect for all of the millions of lives that could be affected by this. It also, I would note, is changing the plans of President Biden, who was scheduled to leave tomorrow for a trip to Germany and Africa. He has now postponed that to be here in the States to respond to this potential catastrophic disaster.
Kelly, appreciate the update. Kelly Lyons there, Bloomberg's very own. You can catch Kelly, of course, on Balance of Power at 5 p.m. Eastern Time, weekdays, Monday to Friday. Somewhat embarrassing for both candidates over the last week on this issue. Much more so, I think, for the vice president just yesterday, undercut by her own president, almost at the same time she was appearing on The View in a news conference.
It was almost simultaneous, right? So The View was asking her about this phone conversation. She didn't mention Governor DeSantis by name, but she said, look, I've picked up the phone, talked to Democrat, Republicans. Some people want to make this partisan. Then the former President Biden was asked about this. Reporters were leaving the room. They're shouting. And he's like, look, Governor DeSantis is cooperating. Actually, I gave him my personal line. And that is what the DeSantis team told me yesterday morning. They had a really positive phone conversation. We don't know what this call is supposed to be about with the VP. And he's getting everything he needs from Biden.
And the vice president doesn't usually call when there's a hurricane.
Usually
which is something she didn't deny in that conversation yesterday.
Usually the Oval Office to the governor.
Up next on this program, Adam Kamins of Moody's Analytics on the potential economic costs of Hurricane Milton. That conversation up next. Tuesday was kind of like Monday, upside down, almost across the board, equities, bonds, and in the commodity market too. Equity futures right now on the S&P 500, negative by almost 0.1%. Similar move on the Nasdaq 100, down by around about 0.1%. A big run for tech stocks. Nvidia extending a 5-day rally. The gains, Danny, in the double digits for that single name.
And we're back to tech supporting the overall market just like that. Just as yields may be coming down, supporting it. It is a macro environment, John, that feels just so supportive of risk. Every single Fed speaker is using the word balanced, that the risks are balanced. They still have a cutting bias, even with the strong economy. And GDP now at 3.2%. Why not buy?
It's just a sense that even if you think the high end of neutral is in and around 4, you've got 100 basis points of rate cuts still to go, and the next 100 is maybe an easy decision. If you switch up the board and get to the bond market, we saw a bit of steepening come back into the curve, led by the front end. Yields down. See it again this morning just on the margin, down by almost a basis point. The 2-year 395.25. The fireworks in the commodity market. Check out Brent crude and WTI. Brent crude snapping a 5-day winning streak in yesterday's session. Big move lower. The biggest one-day slide since early September. At one point poised for the biggest one-day drop, going all the way back to 2022. Anne-Marie, still on Middle East watch here. Brent crude 76.84.
Right, so this might be just a pullback momentarily based off what was going on in China, people questioning whether or not we're going to actually see demand pick up in mainland China. The issue, of course, the overhang, the cloud over this market is what goes on with the Middle East. And potentially we'll get some details today. We were supposed to have the defense minister of Israel come to the United States for these talks. That's not happening. Netanyahu said, no, I'm going to talk to Biden myself.
Have we got closer to some kind of agreement with Lebanon in the last 24 hours? Did that contribute to some of the moves we've seen over the past few days?
Potentially, but then you also look at what's going on the ground, and there's still constant fighting. And Netanyahu does not have the strategic wins I think he wants, even though he's had some wins over the course of the year.
Brent crude down by 1/3%, 76.90. Under surveillance this morning, talks breaking down between Boeing and the Machinists Union, with the strike nearing its 1-month mark. The company and union blaming each other for the impasse. S&P Global Ratings warning it may cut the plane maker's credit rating to junk.
So this was basically a double punch overnight when it comes to Boeing. One, the S&P talking about that it's going to have to potentially go to junk as they're basically just hemorrhaging all this cash. At the same time, potentially you thought we were going to get a deal. And I thought maybe the timing of the deal was ripe because of the fact that these union workers were actually losing access to health care. But no, they say that what Boeing's offering or not offering is just not working, and talks absolutely shut down.
I got to say, it's quite remarkable that they're not getting closer, that neither side is budging. The union saying that Boeing's not backing off of the original deal that they proposed, despite the fact that Google wants to raise $10 billion via an equity offering. How much more difficult is that going to be if they get cut to junk? Time is not on Boeing's side. They're burning through billions every single day that this goes on, and still yet they're not moving on these issues of pay.
Boeing down again this morning. It's negative by 1.4%. Let's talk about Google. The US Justice Department weighing a breakup of the company. The agency saying in a court filing it's considering options to mitigate the tech giant's dominance in search. Ordering Google to share its search data is also on the table. That name's down 1%.
There's a ton of things that could be on the table here to make this a remedy if there's no official breakup of the company. End of exclusive agreements that Google has with places like Samsung, like Apple, prohibiting certain kinds of data tracking, the 32 pages that the DOJ filed, absolutely scathing in what they view Google doing. Google basically coming out and saying this is ridiculous and this goes beyond what we're seeing. But this might drag on for years. What I find so fascinating about this story is that the politics of this, basically, there's a bipartisan push in Washington, D.C. to go after these big tech names.
I just wonder how they do this, how they break up the company or at least separate parts without disadvantaging consumers. I mean, people like the idea that you can pull up Google Chrome, you can just go straight to Google search. No one wants to choose which search engine they go to. Like Google says, I mean, it's the best one. They want to be able to go to their email, their Gmail really easily and go to Maps. People like that all these things are together. If you break them up, are you going to have consumers who actually face consequences, as Google says they will?
You have to say, and I'm not in a boat alone. I think a lot of us do this. If I log onto something and it defaults to Bing, I often just go onto
100%.
Google. Right? You just go onto Google.
Yeah, Google is so much better, and they now have that weird little AI thing that isn't telling you to put glue in sandwiches anymore. So, they're getting better.
Is it fair to say that AI is a bigger threat to them than maybe the DOJ is at the moment?
Well, the interesting thing is that Google seems to have not gone as full force into AI because of this threat. They didn't make acquisitions or push as hard to rival OpenAI. And a lot of commentators have said the reason that they haven't done this is because they know this antitrust threat is hanging over their heads. So it's possible it's already made a difference to Google's behavior.
Alphabet this morning down in the pre-market by something like 1%. A top story for this nation this morning. Hurricane Milton heading towards Florida's west coast as a Category 5 storm with 160 mile-per-hour winds. The U.S. National Hurricane Center expecting it to make landfall at some point tonight with flooding, winds and life-threatening storm surge.
This is absolutely devastating on the human level, which is why you have up to the highest level of office President Biden telling individuals, please evacuate millions of people, which is why you see the highways really clogged. Ron DeSantis late last night gave an interview to the Weather Channel talking about the fact that we can rebuild your homes, we can rebuild your business, but you might lose your life if you and your family stay behind. And then you actually look at some of the business impact. Goldman coming out with what this may cost Disney. Disney really wanted to get people back into the parks. This is not a good time of year, especially leading up to the holidays, and they're going to lose a lot of customers. But obviously, most importantly, is people getting out of harm's way.
Without a doubt, that is top of mind this morning. Let's talk about the economic fallout as well. Economists weighing the potential cost of the damage caused by Hurricane Milton. Adam Kamins of Moody's Analytics writing, the historic strength and path of Milton threatened to make it one of the costliest hurricanes ever to hit Florida. The size and power of the storm somewhat resemble Hurricane Wilma from 2005, which resulted in more than $20 billion in damage. It is likely that Milton will carry a price tag at least that high, but possibly much higher. I'm pleased to say that Adam joins the programme now for more. Adam, welcome to the show on what is going to be a pretty sombre 24 hours and maybe a few weeks, perhaps even months, stretching into 2025 for this part of Florida. Adam, you've mentioned this in some of the research you've done. Are parts of Florida going to become uninsurable, given the frequency of events like this?
That's the risk. And we are certainly seeing this along the Gulf Coast. We've had multiple years now with major, historically strong storms. If this continues, we've already seen a lot of private insurers pull back. We've seen insurance costs rise dramatically. That has an impact on affordability in Florida, which is becoming increasingly problematic. So there's a sort of a vicious cycle that's being entered into here for a lot of Florida.
The Biden administration has also warned that the Small Business Administration would very soon exhaust its funding for disaster loans for homeowners and businesses already in the wake of Hurricane Helene. Now you have Milton. Adam, what is going to be the ability, how expensive and how possible, just given what you're saying about insurance, is it going to be to rebuild some of these places after the hurricane?
I think it depends on the scale of rebuilding that's needed. So if we're talking about an area, south of Tampa, we've seen places like Naples and Sarasota, which are in the potential cone of uncertainty here, that if they get hit very hard, it is certainly feasible to rebuild them. FEMA can pull together more funding potentially. If it's an area like Tampa, which is just so vast and so huge, the rebuilding effort would be unbelievably expensive. It doesn't mean they wouldn't do it, but I'm not sure how feasible it would be to rebuild it back into what it is today.
Adam, can you put some numbers to that? Just how expensive?
So we can say kind of the baseline here. I look at Hurricane Wilma, right? It's similar in terms of strength. That was also a historically strong storm. It was not that large. That is maybe one saving grace here with Milton, is that it's not especially large as hurricanes go. That cost $20 billion roughly in insured losses. We would expect that this number is going to be significantly higher than that. How much more? It really depends on the track. So if there's a direct hit or close to direct hit on the Tampa area, we're talking significantly higher than that. If it's something that hits in an area like Naples or Sarasota or one of those metro areas, then probably that $20 billion is a good starting point, and I don't think it would be dramatically higher than that necessarily.
Adam, do you think this will just force people in the end to relocate their families and their businesses?
It's a really good question, and something we've thought about a lot. I mean, really what we've seen over time is that climate change and hurricanes and the threat of damage, it really has not been something that has compelled people to move out of high-risk areas. I think the thing that could do it goes back to what we were talking about a moment ago, and that would be the insurance market. If portions of Florida that are hit are deemed uninsurable or insurance costs continue to rise really dramatically, higher costs, lower affordability, that's what gets people to move ultimately. I think that's what I'm watching most closely. And as we go after, see year after year of these sorts of storms hitting, I think the impact on affordability on insurance markets, that's what I'm watching most closely. And I do think in the long run, that will compel people to leave. But I would be surprised, barring a direct catastrophic hit on the Tampa area, which is unfortunately within the realm of possibility, but not the most likely outcome. I don't think it's going to dramatically alter the demographics or kind of business formation, anything like that.
That's the Black Swan event that individuals have been so concerned about when it comes to Florida. Are there pockets of Florida right now that are uninsurable?
There are areas that I believe there are options available throughout the state for insurance, but there are places where the private market has all but pulled out, right? And so the state is the insurer of last resort in Florida. The state is to step in and provide insurance in some of those areas. And that is, the question is sort of how sustainable that is, right? The state can only support these increased potential losses and the costs associated with insuring where the private market is not for so long before it needs to raise more revenue, potentially raise taxes in a way that would be very politically unappealing and I think, frankly, unlikely. So I think will come a point where there could be some pockets that are uninsurable. At this point, though, the state is still able to step in and you can get insurance pretty much everywhere in Florida.
Adam, let's put a bow on it and attempt to put it all together. We've had Hurricane Helene, we've got Hurricane Milton, and we had a port strike somewhere in between for a couple of days. It's ended. Adam, can you tell us how you're thinking about the economic fallout across the country in the months to come and what the incoming data might look like, how distorted things may well be?
Sure. So I don't think that the port strike had the potential to be a macroeconomic event nationally. We are fortunate that that was resolved within a few days. If that had dragged on, I think that could have potentially weighed on GDP growth by a few percentage points and maybe turbocharged inflation a little bit. That was, I think, by far the biggest risk. Helene, Milton, those are regional economic shocks. So certainly if you look at the Asheville, North Carolina area, which has just been devastated by Helene, obviously the human toll is what matters most, but the economy of that part of North Carolina is, you're going to see very clear declines in data and eventually in overall output once that's available. If, depending on where Milton makes landfall, that will certainly be evident in the data. We often see declines in employment in the month or two after a major hurricane hits that are quite significant. I don't expect that this is going to meaningfully alter the national numbers. The most likely way for it to show up would be kind of as a setback, nothing that would really alter the trajectory nationally. But if it makes a direct hit on Tampa and potentially affects Orlando as well, you could potentially see that show up in the payroll survey, which is based on, I believe, on this week.
Got it. Adam, thank you, sir. Adam Kamins there of Moody's Analytics on the economic fallout and some of the difficulties we might see in the state of Florida. If you're watching the Fed speak at the moment, one individual that might be worth paying closer attention to, Raphael Bostic. Many of these states that have been hit fall under his coverage, the Atlanta Fed president. He'll be speaking a little bit later at the Builder Developer Lender Council at the Greater Atlanta Home Builders Association monthly meeting. I'll get all of that out at 8 a.m. Eastern time. So just look out for some comments from him and see if he addresses some of the questions we've got at the moment about the economic fallout of these hurricanes. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. The Pentagon says a U.S. visit by Israel's Defense Minister Yoav Gallant has been postponed. Bloomberg has learned it's because of a last-minute objection from Israeli Prime Minister Benjamin Netanyahu. President Joe Biden is set to speak with Netanyahu later today. Meanwhile, Taiwan semiconductor shares are rising about 0.7%. That's after sales at TSMC beat street expectations as the company posted a 39% increase in quarterly revenue. NVIDIA and Apple's main chip maker will disclose full results next Thursday and give investors a deeper look at the staying power of AI-driven growth. And our own Lisa Abramowitz sat down with JP Morgan Chairman and CEO Jamie Dimon in London and asked him if mid-sized banks should be able to merge.
They should be allowed to merge Their boards of directors should be allowed to make that decision based on what they think is in the best interest of the shareholders. This notion that the government should get involved in every single little bank deal, I think is just wrong.
Diamond also told Lisa he's not planning to run for president. As for this election season, Diamond says he has yet to make a decision on whether to endorse a candidate. That's your Bloomberg Brief. John?
Yahara, thank you. Fantastic exchange between Lisa and Jamie Dimon. Catch the full exchange on Bloomberg.com and on YouTube as well. Up next on the program, pricing in election risk.
It's this period, the weeks before the election, when uncertainty tends to be highest. That leads to higher implied volatility, a little bit of market weakness. But of course, the flip side of that is after the election, that uncertainty moves lower and stocks usually rise higher.
That conversation up next, live from New York. This is Bloomberg. Live from New York City this morning. Good morning. Let's take a snapshot of the price action together and start with the equity market on the S&P 500 at the moment. We're just about unchanged. Decent day of gains in yesterday's session. Though, as we indicated a little bit earlier this morning, the bulk of this, a lot of this came from big tech. The run that we've seen over the last 5 days on a single name, and that single name is NVIDIA. Danny, it's worth going over again. NVIDIA in 5 trading sessions, we're talking about gains of more than 10% just across 5 days.
Yep, and it overtook Microsoft again as the second biggest company in the world. And it comes at a time when so many people have said, look, we're about to enter earnings season and there's going to be great breadth. Other companies are going to be catching up to big tech. It's the other 493. You can say that as much as you want, but that's not what's happening. As we start to price out some of the Fed cuts, as the economy chugs along, people are going back to the safety of big tech.
And now we have to think about a hurricane and the potential fallout from that hurricane. Anne-Marie went to a single name. Let's bring up Disney and get the latest from Goldman. You mentioned Goldman, Anne-Marie. Hurricanes Ian back in 22, Dorian back in 19, Irma 17, Matthew 17, forced the Disney company to close for 1 to 2 days. And in Irma's instance, multiple cruise itinerary cancellations as well. So Disney World down in Orlando, one to watch maybe in the next several days.
Especially when you see how much Disney now is making money off of things like theme parks. It's really such a big part of their business right now. Goldman, specifically, they said we estimate 150 to 200 million in adverse impact because what is going on with this hurricane in Florida? So
that's the equity picture at the moment. We've talked a lot about Google already this morning. I want to sit on the bond market just for a moment. The 2-year at about 395, the 10-year just about unchanged, just north of 4%. The difference between 2s and 10s still positive by around about 6 basis points. This came from Barclays. We've been arguing that a dovish Fed reaction function in the face of economic resilience actually argues for higher rates, which would argue potentially, Danny, for rates to stay above 4% on a 10-year if the economic data continues to come in this fashion.
Well, that was part of the reason that 10-year yields, even before the Fed decision and then after, started to move towards that 4% level. We've been seeing a sell-off in duration for some time, and the assumption that the economy is still strong, and maybe the Fed, after having cut 50, put a floor under it. And then again, you get these people arguing it is time to go in and now buy bonds, that yields finally look good. But you hear like someone from Ray Dalio yesterday who said, I'm sorry, the volatility just makes me not want to be in this market. He, for his part, is short bonds.
The 10-year right now at about 4%. Look out for Fed minutes a little bit later on this afternoon. Under surveillance this morning, pricing in election risk.
The question is uncertainty. And actually, that is the key dynamic that we've seen historically around elections. If you look at every single presidential election year, uncertainty is really the most important thing for stocks. And it's this period, the weeks before the election, when uncertainty tends to be highest. That leads to higher implied volatility, a little bit of market weakness. But of course, the flip side of that is after the election, that uncertainty moves lower and stocks usually rise higher. We expect the S&P to repeat that pattern this year.
So here's the latest. Election day just around the corner, but the outcome could be days, weeks, maybe even months away. The team over at CBOE writing the following. The term structure of VIX futures continues to signal increased uncertainty about the election outcome on November 5th, which dissipates by the Friday after the US election. This implies the market is underpricing the probability of a prolonged contested election. Joining us now to discuss is Rob Hocking of CBOE. Rob, good morning to you.
Morning. Thanks for having me.
How difficult is that, the way things are priced this time around compared to, say, previous elections in 2016?
I think you historically have seen the month leading up into the election a pop in the VIX, roughly, call it 10 vol increase in the VIX. And with that, right now the market is pricing in, if you look at the VIX term structure, the October future is really pricing in that volatility premium. It's been there pretty much all summer. Yesterday the October future broke 22, settled right around, just shy of 21.5. And what you see after that in the term structure is really a decrease. So per what you just brought up, the market's really saying, okay, there's a huge uncertainty in the election itself, and then right afterwards, vol goes kind of back to normal, back closer to that long-term historic mean.
In 2020, though, it took days to know what was the outcome. Did you see when basically we were still hanging in the balance, waiting to find out that people were buying in to protect themselves?
Yeah, absolutely. I think this time around, the market's pricing in something different. Us as an exchange, it's, we don't really have an opinion on that. I think it's more, using the VIX. The VIX is a good instrument for this. It's something that uses bids and offers taken from the market. So actually what the market is pricing in, where they're willing to commit capital. And in this situation, the market feels like this one's going to be determined pretty quickly.
The tail risks do seem quite acute at this particular time, not even just the election, but a hurricane and geopolitical concerns. Where do you see those tail risk hedges showing up, if at all?
Oh, they're showing up. It's a great question. They're showing up in SPX puts and in VIX calls, with no surprise. On October 4th, if you look at the put call ratio, which is something we like to look at, close to 2.25 puts to every one call traded in SPX. That is much higher than, I would say, the longer-term historical mean, which is around 1.7, 1.8, showing that demand for downside hedges in SPX puts. And all year long, we've had very big volumes in VIX calls, a lot of demand for VIX calls. A lot of that, you could say, is the overall absolute level of the VIX. It's been lower. It's been trading below its long-term historical mean for most of the year. And with that, you have an ability with VIX hedging, with VIX calls, to say the VIX can increase dramatically from, say, 17 to 34 to 35, and you get kind of a bigger bang for your buck on your hedges when it comes to using VIX calls in that type of move.
Earlier in the year, the characteristic, at least of single stock volatility, was protection on the upside, of the right tail being the new left tail. John mentioned that tech, again, is carrying this market. Do you see that demand coming back in, that people, not even just from these geopolitical events, but see further gains and want to be there for that?
Absolutely. I think options volume as a whole is increasing, and a lot of that is due to investors wanting to define their outcome. Wanting to have, reduce volatility in your portfolio and have a better idea of where your portfolio can go and where that outcome can take you. And so we continue to see increases in options usage. I think it's interesting to see the balance between the shorter term expiries, where you're seeing a more balanced 1-to-1 put to call ratio. And that's to say daily events or trying to hedge out shorter term events is much more balanced to the upside, to the downside. And then our longer term exposure is definitely more to those kind of, black swan, tail risk type events where you're seeing that put call ratio and you're seeing more downside trading in SPX.
Rob, appreciate the update. It's good to see you, sir. Thanks for coming in. Rob Hocking there of CBOE. Up next on this programme, the second hour of Bloomberg Surveillance just around the corner. We'll catch up with Richard Chilton at Chilton Investment Company. We'll speak to Jessica Taylor of the Cook Political Report, Hugh Van Steenis of Oliver Wyman on the future of asset management and what it means for some of the big banks on Wall Street, and Craig Fugate, the former FEMA administrator under President Obama. Don't miss that. The second hour of Bloomberg Surveillance just around the corner, with equity futures erasing this morning's losses on the S&P 500 just about unchanged. From New York, good morning.
Could there be a more dramatic drawdown? I think that's certainly a higher probability event.
This market lacks anchors. And until we restore some sort of anchor, you're going to have this volatility.
It really looks like more and more parts of the equity market are able to raise profits.
The health of the stock market's going to depend on earnings.
There's plenty of legs to this bull market. There's plenty of drivers for that bull market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance begins right now with equity futures on the S&P 500 just about unchanged. On the S&P, on the Nasdaq 100 too. On a Russell, we look a little something like this. We're down by almost 0.1%. One single name we keep returning to, it's Alphabet. Google in the pre-market down by about 1%. As we said earlier on this morning, it's the DOJ knocking on the door of Alphabet this morning. Danny, that stock is down by 1%.
It also underscores the difficulty of relying on too few stocks. Yesterday, it was big cap tech that led us on the way up, Alphabet being among them. Here's one of the clear risks going forward. So many people have said any sort of idea that these big tech stocks would be broken up, it's not a reality. You can keep buying them. It's not a risk. The risk needs to really be priced in now.
John, to your point earlier, the fact when you sit down at a computer and you see Bing, you immediately, likely most of you will go to google.com. If you wanted to find out about this antitrust case, you probably Googled it. And this is what the DOJ filing gets into the heart to. Quote, Google controls, and basically what Google does, is indispensable to the lives of all Americans, whether as individuals or as business owners, and the importance of effectively unfettering these markets and restoring competition cannot be overstated. So they're calling for a breakup, but there's other ways also potentially they can do to remedy this case.
When you get this big, when you become this dominant, you attract this kind of attention. Let's tee up NVIDIA. Let's talk about NVIDIA getting even bigger. 5 days of gains, a rally of more than 13%. In that period, Danny, we're talking about adding an additional $390 billion of market cap.
We're back to that old thing of if you check where NVIDIA is, you can probably guess where the market is going. Yesterday, NVIDIA contributed 15 points to the S&P 500's gains. That's a third of the gains yesterday attributable to one stock. We were speaking with Ed Yardeni yesterday, who was worried about valuations in this market. If you worried about them yesterday, you're certainly worried about them today, especially going into an earnings season where the rest of the 493 is supposed to be picking up the slack. It's supposed to be widening breadth. We're not seeing it.
That stock is up by another 1.2% in early trading. Your week ahead, your next 24 hours looks a little something like this. Later on this afternoon, some Fed minutes from the Federal Reserve's last meeting. You'll get those at 2 p.m. Eastern time. Tomorrow morning, the big data point of the week, CPI in the United States of America at 8:30 Eastern time. Then we're getting closer to this, Danny. Looking forward to it. Friday, earnings from JP Morgan and Wells Fargo.
And to get a read on this economy, because the macro data has been confusing at best. As Mohamed El-Arian put it, this market lacks an anchor. Can the earnings season serve as some sort of anchor? Already we've heard from Pepsi. Those results weren't great. Still a value-conscious consumer. We're going to hear from Delta tomorrow. And then, yes, the banks, the credit conditions will be vitally important. And maybe it can serve as a better read, again, as things like jobs data really impacted by some of the bigger events going on in the United States.
A lot to work through the next several days. Equity futures on the S&P 500 just about unchanged. In the bond market, still holding on to a 4 handle. The 10-year up by almost a basis point at 4.02%. Danny alluded to it just then. The economy. And there's a lot going on in this economy right now. The prospect of Hurricane Milton being a Category 5 storm when it lands on Florida later on this afternoon, this evening into tonight. I think the AccuWeather forecast that we spoke to a little bit earlier on this morning was talking about 2 a.m. Eastern time being the time for landfall a little bit later.
Yeah, 2 a.m. And then it's not just the landfall, it's the storm surge afterwards. In an area that has already been impacted by Hurricane Helene, you don't have the same natural protection that you maybe did before. What is going to be the impact of having 5.5 million people told to leave a region, of having roads stuck up with these people, people being unable to get gasoline in their cars, and then you add on the human toll? It could potentially be devastating.
Exactly. If you're trying to get out, can you even get gas in your car? Gas Buddy talking about more than 1 in 5 gas stations right now are out of gasoline. We spoke to an analyst, though, from Moody's, an economist, talking about the fact that this is going to reverberate for a number of jobs reports in the next few months, because it's going to be very challenging to read the economic data coming out of a place like Florida, that 1-2 punch, Jonathan, that no one wanted to see.
This is the lineup for the next 60 minutes on some of these issues. Richard Chilton of the Chilton Investment Company as the DOJ weighs breaking up Google. We'll catch up with Hugh Van Steenis of Oliver Wyman on why private credit could be the Ozempic for big banks, and former FEMA administrator Craig Fugate as Florida braces for Hurricane Milton. We begin this hour with stocks slipping just a touch as the DOJ weighs breaking up Google in a historic antitrust case, putting other big tech companies on alert. Richard Chilton of Chilton Investment Company says in today's market environment, the highest quality companies have been able to strengthen their economic moats and grow their market dominance at the expense of small and mid-sized companies. Richard joins us now for more. Richard, good morning. Welcome to the show.
How are you today?
I'm good. It's good to see you. Let's talk about some of these single names and pick out one. Let's take Google. The threat of getting too big market dominance becoming a problem, and the DOJ knocking on your door and maybe blocking your advance as a company for years to come. How do you think about that big issue?
Well, I mean, certainly with Google, we could see in Commissioner Khan's the way that she's been holding herself that large tech was on her list, and they're great companies. These are all great companies, and I think that where they're looking at Google is whether or not they used their scale to be able to force feed their search with respect to Apple and others. And certainly that came over in Europe where they got binged for that, and they had to, pun intended, and they had to open it up. It's still the best product out there for search, and so my guess is that when we get the ruling from the government, it's going to be pretty draconian. And we're expecting the stock to go down on that because it's going to be pretty severe. My guess is as they work through the situation, I don't think they're going to break up Google. I think that they'll put remedies in. And, I think the stock will recover from that just because the remedies won't be as bad as what is going to be looked at when they first come out.
Going after big tech is really a bipartisan issue. It was the Trump administration that first talked about going after Google and filing that antitrust suit. When you look at what's going on in Washington, especially with big tech, does that make you as an investor want to stay on the sidelines?
Yeah, I mean, I think that, look, there's a lot of these companies are, as I said, really good businesses, but they've had huge runs and there's a lot of expectations built into them and their valuations are very full. There has been issues that have been come out there with respect to privacy issues with teens on places like Meta, Facebook, and others, Instagram. And some of these need to be addressed from a societal point of view. And that doesn't mean that they can't continue to grow and serve their audiences. But we do need some safeguards, and I think it's smart that we're doing that. TikTok is one of those, which, is a very, President Trump came out with that, but it's a very big issue because of the data collection that they're doing, and it's falling into the hands. I think it's interesting because in the old days with linear TV, no foreign entity could control more than 20% of any broadcast or media outlet. Period.
Rupert Murdoch became an American citizen.
Exactly, Anne-Marie. But what's happened? Have we forgotten that just because it was linear TV? Here you have one of the largest media companies in the world who is influencing the lives of Americans, elections, people, and collecting data. And it's completely owned by a foreign entity. That doesn't make sense.
It feels like we're almost in a new world, and you talk about this in your notes, that you say we're in an era of, quote, creative destruction. What does that mean?
Well, Alfred Schumpeter, who was an Austrian economist, coined that term, and it's kind of, in a very generic sense, it's the big getting bigger by eating the smaller. And we've been going through that for a very long time. That's why we don't have any buggy whip manufacturers anymore, why we don't ride around in carriages, because we have cars. And it's been moving down that path for a very long time. But the pandemic accelerated that. So think of a very gentle snowball going down and getting bigger, and then all of a sudden getting really big because it hit a steep slope going down. And that's been happening. And it's a really difficult time to be managing small businesses in America, both public and private, in part because they don't have pricing power. They have tough times with sourcing workers. Their pay packages are higher. There's no supply chain that they can really rely on. And as a result, the bigger getting bigger, and that's creating opportunities in a whole handful of companies that are going to make them incredible businesses for the next 10 to 20 years. And that dominance is just increasing.
There does seem to be, though, in some of the biggest companies, stress taking form in the way of corporate turnover, of executive turnover. Boeing, one example, having its own idiosyncratic issues, but places like Nike, for example. Is there something unique about today's environment that is pressuring corporate executives in a way that it didn't before?
Well, Danny, you mentioned a very interesting case study with Nike, and Nike is being eaten. and so companies have to grow and change and evolve and keep up with things, or else they're going to fall victim to AOL and Yahoo, the Yahooism, okay? And that was a perfect example in AOL and Yahoo. Nike has seen in the last 5 years, companies like Hoka reach $2 billion in sales, reach $2 billion in sales. They are not the preferred, brand anymore, certainly in apparel, which they had the premium edge on. And now, just do it, Nike. I mean, it was really now they're kind of an also-ran in a brand, in a category that has no pricing power. So they got some serious issues, and it was because of the insular nature of their business and their management for a long time. And there are others out there like that. And it's going to take a long time. Starbucks is one that's like that too. And we have a lot of respect for the new CEO of Starbucks. We owned Domino's we owned Domino's for 15 years when he was there and worked as Magic. And he's a great CEO, but it's going to take. You can't turn ships like that around on a dime.
It seems like there's been this real concentration for CEOs to understand what's actually happening within the company, within the floor. Home Depot is a great example of this, and I know it's one of your companies in your portfolio too. Yesterday, the story came out that they're telling their employees in the executive and corporate office, you need to do 1 day on the retail floor. 8 hours once a week, you need to be on the floor. It's a company that's had a difficult period coming out of the pandemic after everyone pulled back from their spending on home decorating and home refurbishing. What do you make of this strategy saying, get back to the people, essentially?
I like that strategy. And when Home Depot was started, everybody had to do their stint. It's kind of funny. Some of the better companies used to do that. I remember when I first started out in this business, I covered consumer and I covered restaurants. This was 1983 when I was working in Alliance Capital. And to cover McDonald's, either as a buy side or a sell side, you had to go to Hamburger U. And you had to spend a day at Hamburger U. And it was pretty hysterical seeing all these, pedigreed Wall Street analysts flipping burgers. But they used to make people put on the orange jacket, the orange vest, and go and work on the floor. I think that's part of a culture, and I think it's really important. You can't be in the retail business without understanding what people want, to buy. And the thing that's interesting about Home Depot, which dovetails into this whole bigger getting stronger, is when we first bought Home Depot, I've owned Home Depot for forever. But when we first bought it in this last go around, which was January 19th, 2010, it had a TAM, a total addressable market of about $180 billion. And it served the retail do-it-yourself medium. Today, that TAM has expanded to $950 billion, and 52% of their business comes from servicing the pro. And so they're not just what they were, they're now basically like a wholesaler, like of building products to the professional, which gives them a lot more ability to, because since 2017, they've been increasing their supply chain, they've been bringing in stocks, and a lot of the smaller local places can't do that. They don't have the merchandise. They can't get it for the price. So it makes that business incredibly attractive going forward.
Richard, thoughtful stuff. It's got to catch up again. Richard Chilton there on the latest situation with corporate America. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira Hackers. Hey, Yahira.
Hi, John. Florida is bracing for Hurricane Milton. AccuWeather reporting the Category 5 storm is expected to make landfall around 2 a.m. Eastern tomorrow morning. Milton is packing winds of 160 miles per hour, a speed strong enough to tear homes apart. The Tampa Bay area is also facing a storm surge that could reach as high as 15 feet, which would lead to widespread flooding. This will be the second major hurricane to strike Florida in less than 2 weeks. Meanwhile, Rio Tinto is making its biggest acquisition deal in 17 years. The mining company agreed to buy Arcadium Lithium for $6.7 billion in cash. Rio will pay $5.85 per share of Arcadium. That's a 90% premium to its closing price on October 4th, which is before Rio first confirmed that it had made an approach. And as we mentioned earlier, our own Lisa Abramowicz sat down with JP Morgan Chairman and CEO Jamie Dimon in London and asked him if he sees a deterrent for companies to go public.
In the United States, we've made it hard to go public. We've eliminated research on smaller companies. The costs are much higher. Those litigation expenses are higher. Filing with the SEC is higher. So I think it would be really incumbent upon us to try to make it easier and cheaper to go public.
Diamond also told Lisa he thinks the Fed was late to raise rates, but they did the right thing by lifting their foot off the gas. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, Florida, bracing for disaster.
This storm is expected to make landfall on the Florida Peninsula, the west coast of Florida, sometime late Wednesday evening, maybe early Thursday morning. And really, almost every place on the west coast of Florida could get major storm surge.
The latest on Hurricane Milton, up next. The equity market looks a little something like this. We're down by 0.06%. In the bond market, you're still in and around 4% on a 10-year. In the commodity market, we'll pull back once more. We're down by 0.8%. WTI, 72.96. Under surveillance this morning, Florida, bracing for disaster.
This storm is expected to make landfall on the Florida Peninsula, the west coast of Florida, sometime late Wednesday evening, maybe early Thursday morning. I know that there's a lot of folks who have evacuated, who are in those areas, and you absolutely could get whacked with really serious storm surge. Really, almost every place on the west coast of Florida could get major storm surge.
So here's the latest this morning. More than 5 million people being urged to evacuate Florida's Gulf Coast, with Hurricane Milton expected to make landfall as soon as this evening. Governor Ron DeSantis declaring a state of emergency in 51 counties and holding calls with President Biden on preparations for the storm. Joining us now is Jessica Taylor of the Cook Political Report. Jessica, let's talk about the politics, the electoral politics of all of this. It's not just Florida, it's parts of Georgia. We've seen western parts of North Carolina become absolutely devastated, eastern parts of Tennessee as well. When you look at some of the races that you cover and you acknowledge the fact that we're talking about 51 counties in a state of emergency across Florida, how many of these races become very, very difficult to gauge now, given what's playing out following Hurricane Helene and Hurricane Milton?
I mean, I think in the past few weeks, it's been North Carolina because that's such a focus at the Electoral College level, and those areas of Western North Carolina, with the exception of just Asheville, which is very Democratic. But overall, those very rural counties are incredibly Republican. And now it becomes a question of, are people able to get absentee ballots? Do they have their IDs? Do they have to get replacements? Are there going to be mobile voting shelters? And, for a lot of people, voting may not be atop their mind when you're worried about, losing your home or different things and just, finding basic necessities. So I think polling in North Carolina, I think for these last few weeks is just going to be difficult, if not impossible, to get that. But like I said, we just don't know how that's going to affect turnout. But given those are very Republican areas, that certainly, could hurt Trump in that area. And then, you look at just the politics of the misinformation that we're seeing spread, blame that even Republicans in the state there, the Senator Tom Tillis has worked to refute that, this FEMA money that is coming in is separate than money from FEMA that was meant to address the border crisis. And then, Georgia, how does that affect it? That's the state that's probably been slightly trending in Trump's favor. And then, in Florida, there is a key Senate race there. Florida is no longer the presidential swing state it once was. But, I think the focus right now rightly is on helping these people in the path of the storm, ones that have already been affected by Helene. And then I think in the coming weeks and days, sort of in the aftermath, I think we'll be addressing how this affects voting and what needs to be done.
Jessica, you make a good point. When it comes to North Carolina, it's really about the Electoral College and the top of the ticket. When it comes to Florida, though, that Senate race could be really impactful. What are you looking at with the Cook Political Report into how much that is leaning towards incumbent Rick Scott's win?
I think Florida is still a difficult lift for Democrats. That, we still rate this race as likely Republican. There's some money that, could have been pouring more into it. But I think as Democrats need another seat, especially as Montana moves out of their direction to keep the Senate majority, Texas is becoming the more likely pickup. We're seeing more money pour into that other than in Florida. And then right now, if Florida, state like Florida, it's about communication. It's about getting your message out. And people aren't focused on political messages right now. So I think that's also made it more difficult. But I still see Florida as a harder lift for Democrats, certainly, when it comes to the Senate.
I want to get your latest on this call in Wisconsin. You say now the Senate shifts from lean Democrat to toss-up. Why? Mm-hmm. This is an incumbent seat.
Yeah, so we've seen some of these Democrats outpolling Kamala Harris. Tammy Baldwin there, the two-term incumbent, was ahead of her. I think Wisconsin is probably as close to an evenly divided state as we have. In our most recent swing state polling that we did at the Cook Political Report in partnership with BSG and GS Strategies, we found this at a 2-point race, 49 to 47%, Baldwin having a very narrow lead over her Republican challenger, Eric Hovde. He's a wealthy businessman, has put about $20 million of his own money into the race. The spending, which had been favoring Democrats, is now more at parity. Internal polls from both Republicans and Democrats mirror our own polls that this is a margin of error race. And so we've shifted this rating. I still think Montana and Ohio are the most likeliest Republican pickups in that order. But then I think it becomes a question of sort of these next blue wall states, and Michigan, but increasingly Wisconsin, we see just becoming a much tighter battleground. And I think, again, that's just a function of that Republican voters are coming home. In our poll, we saw Hovde have an 11-point swing among independents toward him. And so I think just, the last Senate race that we had in Wisconsin in 2022 was decided by 1 point. So these are just very, very close elections.
Jessica, your polling still shows Trump holding a sizable lead when it comes to who do you trust with the economy. But you note that the August advantage he had over handling inflation essentially was wiped out. What do you think changed?
I think that Harris is trying to communicate more on this, separate herself from the Biden administration at times, but talk about affordability and different things. And I also think that, Trump's emphasis on tying her to Bidenomics hasn't necessarily worked. And then I also think as we look at some of the economic indicators with gas prices going down, we'll see where that remains for the rest of the month, of course. I think that's one of the biggest consumer confidence indicators that we have, just because as you're driving around, you're very cognizant of what the gas price is and different things. And then with the, with interest rates going down as well, I think, food prices still remain very high. But I think that Harris has come out in many of these regards and portrayed herself as competent on this. So yes, on inflation, that was a very noteworthy number. Overall in the economy, Trump still has a more narrow edge. Immigration, though, is the big issue where he still has the biggest edge over Harris, though that's also increasingly tightened. But, when it comes to issues of democracy, on abortion, that's where Harris has the biggest lead over Trump.
Jessica, always a clinic. It's good to hear from you again. Jessica Taylor there of the Cook Political Report on some of these races across the nation. The most overused phrase of the last 2 months, things are finally balanced. It's a close race. How many times have we all heard that? It's getting closer. It's getting harder and harder to call.
What struck me, though, yesterday on The View was Kamala Harris's answer to what distinguishes her from Biden. There's not a single thing that comes to mind in terms of, what has been impactful from the Biden administration. And Republicans really harped on that.
It's on repeat on social media yesterday. Coming up on this program, Hugh Van Steenis of Oliver Wyman on the state of the banking sector ahead of earnings due later this week. From New York, this is Bloomberg. Equities, a little bit of a struggle on the screen this morning. We're down by almost 1/10% on the S&P 500. Yesterday, a decent day of gains on the S&P, driven by some major moves in big tech. We've been talking about it all morning. This 5-day run through yesterday on Nvidia, gains of 13% plus. We're talking about $390 billion of market cap added to a single name in 5 sessions. We're up another 1.26%. This morning in the pre-market. That's the equity screen. Switch at the board, turn the page and get to the bond market story. The 2-year at the moment, 395, just off 4%. The 10-year, that move sticks. How many times have you heard this over the last few days? We're in the buy zone. 4% to 425. You've got another chance of getting another bite of a 4% yield in America. Take it, Danny. That's P. Jim's argument.
Do you want to buy ahead of a CPI report, though, which seems to have taken on new importance? The idea that the labor market is sound, the economy not only is chugging along, it is quite strong, 3.2% on the Atlanta Now GDP tracker. If inflation is a worry again, can you really buy at 4%? If it could be more than 4%, given tomorrow's data.
CPI, 8:30 Eastern tomorrow morning. Let's turn the page and get into the commodity market. Here's the picture of things right now on Brent crude and WTI. Brent crude was on a 5-day rally. 5-day winning streak. We snapped that yesterday. We broke it with the biggest one-day slide since early September. Almost the biggest one-day drop going back to 2022.
I still maintain this has to do with what happened in China. Basically, you thought China was going to do more in terms of stimulus. They didn't. They said we'll meet our growth forecast, but a lot of people are concerned that that's not going to happen. So this was really the demand side pulling back. But the fog still maintains over the Middle East on what is going to happen. And potentially we will see more money to the upside in the oil market because of that risk premium. Pierre Andron yesterday getting back into this trade that he exited over the summer. And he thinks about $10 to $15 potentially from 80 could be on Brent.
Pierre Andron on copper. Still thinking about what he said on copper. He said that we could see a multiple on copper, 3-4 times where we are in 5 years. I found that amazing.
Yeah, and I mean, so much of this is kind of like the long-term transition of reasons you could be bearish of maybe China, the economic stimulus isn't going to be as good, all of this. But he really talks about the transition is happening and these longer-term trends that allows copper to make a move like that. Again, when that had kind of fallen out from the floor, back in concentration again for him.
Copper down 0.6% on the screen right now. Likewise on crude, WTI $73, Brent crude at about 77. Under surveillance this morning, Hurricane Milton churning towards Florida's Gulf Coast as a life-threatening Category 5 storm. It's expected to make landfall tonight near Tampa Bay, just 2 weeks after Hurricane Helene devastated many areas.
This is devastating, and basically everyone is just bracing for the impact right now. And now this was, Jonathan, as you've been calling it, the 1-2 punch no one wanted. I spoke to Governor DeSantis' office. They said that this was the black swan event that they always worried about, and it's actually happening. He's basically just hobbled up now in their emergency center, fielding calls, talking to people like the President of the United States. Yesterday, President Joe Biden confirmed what already the DeSantis office told me, which was the president gave him his personal number. Call me directly if you need more, because they are so concerned about the impact of this hurricane.
And we can't forget that in North Carolina, there are still people without food, cell phone service, basic supplies. There's still people there who are in need at a time when FEMA is quite stretched. Mayorkas, the Secretary of Homeland Security, continues to emphasize we have enough money for these short-term things, but otherwise, we're in the trouble for the long haul. Him and Biden both have called for Congress to come back and approve some sort of longer-term budget, saying we don't need Band-Aids. But it's putting out multiple fires. It's another hurricane after so many regions are already facing devastation.
The former FEMA administrator on this program in about 10 minutes' time, so look out for that conversation. Here's the latest in the Middle East. Israeli Prime Minister Benjamin Netanyahu is set to speak with President Biden later today to outline the nation's plan for retaliation against Iran. The two leaders haven't spoken since August. Today's call coming after Israel's defense chief abruptly cancelled a trip to Washington.
It also comes, today's call, after these remarks that President Biden allegedly said about Bibi Netanyahu were released to the press through this Bob Woodward book. And I'm not going to quote them here because, quite frankly, they're not acceptable for a morning show. But basically saying that Netanyahu is a bad guy. Reading the tea leaves of this, if you're the U.S. administration, you want to slow down what Israel is doing, you would send your defense chief over to the United States, because there's no way that they're going to launch a retaliation attack on Iran when your defense chief is in Washington and not in Jerusalem. So what this says to me is potentially it is more imminent now than I would have thought at the start of the week.
So we just sit here waiting as we have been for the last 2 weeks or so. Here's the latest on China. Put this one in the diary. China's finance minister planning to announce on Saturday fresh moves to further strengthen fiscal policy. China's State Council Information Office confirming the upcoming briefing as the country's world-beating stock rally loses steam. The CSI 300 getting hammered overnight, down by 7%.
For what it's worth, this is the body that would announce more stimulus instead of like we heard from earlier this week. But I think you can even see from the market that this idea, everyone expecting a massive package of stimulus, has kind of fallen by the wayside. Volatility makes you think twice about investing in Chinese markets. And just to put a fine bow on it, expectation setting for an opaque market is so difficult. For whatever these policymakers are trying to do, it is almost impossible to really discern it just because it's a difficult market to read, and it's almost intentionally so. They've made it that way.
Are you tuning in for the briefing on Saturday?
I don't know if we'll get much from it. Hey, Nomura says that they should, everyone should be calm. So that's a reason I can stay home on Saturday and not pay attention.
It's not just that he's going to be briefing the press. He will also be taking questions. So I hope those reporters go in with some hard-hitting questions.
Look out for that this weekend. Do you get hard-hitting press questions in China press briefings? Does that happen?
Likely not, but tune in.
OK, let's turn to the financials. Big bank earnings kicking off with JP Morgan and Wells Fargo on Friday, followed by Citi and Bank of America next week. Hugh Van Steenis of Oliver Wyman writing the dynamics between traditional banking and private lending might be changing, saying this: what we are seeing is the retrenching of the banking system, where banks parcel the riskiest slice to private credit, providing less risky lending themselves. Private credit could be the Ozempic to help banks on yet another diet. I'm pleased to say that Hugh's with us in New York. Hugh, it's good to see you again.
Lovely to see you too. Thanks for having me.
Thanks for joining us. Let's talk about some deals that came up in the last week. The one that jumped out for me and for many of us, Citi and the partnership with Apollo on $25 billion worth of deals. What does that mean to you? And do you think that's kind of the blueprint for how these companies will work with each other in the future?
Look, I think this is one of the deals which sort of does change the conversation. We've seen 14 partnerships between private credit and banks in the last 12 months, up from just 2 the year before. And I think it's because the banks are realising that they need to shed risk. Part of it is because they're anticipating Basel Endgame. Now, even if it's not going to be anywhere near as bad as they first thought, they still need to diet. And so what they're trying to do is now slice up their balance sheet and put the riskier pieces out. So in the case of the Citi deal, is to lay off some of the non-investment grade risk. But I actually think some of the other interesting deals are ones where actually private credit is also replacing investment grade. And I think that's one of the most interesting things in private credit at the moment. By having insurance assets, as we were chatting about, they're lowering their cost of capital and they can then become much more competitive for IG assets.
When you say the riskiest parts of credit, do you mean the most profitable parts of the bank business model are going to private markets? Is that another way of putting it?
So it can be a little bit more subtle than that. So it depends on the type of trade. So let's take, the US has now allowed synthetic risk transfer, so people can actually slice up their sheet. They're almost like do your bell curve. They're slicing off the bottom couple of percent. So the riskier piece, which means they don't have to hold as much capital. So what they're doing is much more an optimization trade than simply just shedding risk. But yeah, I mean, let's be clear. In life, people either pay to win or pay not to lose. The largest banks are saying, we can now do deals with private credit. We can actually write even more loans, take a bigger ticket, do more share of wallet, but we need to lay that off. The ones who are playing not to lose are really worried because they're worried that private credit will actually encroach on their sheet and they'll become, as one CEO told me, dumb pipes.
Well, with all of those worries, as private credit just gets bigger, there's always going to be someone out there who says there's a risk, there's a black box, more debt there. I thought it was interesting, the SEC's top enforcer early in the year made an argument, not of that, but just saying there's just too much concentration, that it's not necessarily that it's a black box, but it's just too few people chasing and owning these assets. Apollo talking to John about doubling in size over the next 5 years. Is there a sense that this is becoming an industry too big to fail?
No, I think the systemic risks that people worry about seem to be overplayed. I mean, look, as I think you had a great interview with Mark last week, they're a small business in the context of asset management. You've got BlackRock and others that are, north of 10 trillion. You've got Pimco as a couple of trillion. So I think in the context there, I think that's not the case. And also remember, you're not getting counterparty risk to Blackstone or Apollo. You're getting counterparty risk to the asset they run. So what you really want to make sure is, are they thoughtful about their credit decisions? Have they scrubbed the sheets down? And for that, you need investment research. And just like your program, you need, credit is a bit different. You can't do it with sort of 5 guys in Westchester. You need a few more people because you need to originate the assets. And actually, I think, therefore, scale actually helps them originate assets. I mean, I don't know how you see it, but I see that the big firms are really breaking ahead. So if you look at private credit overall, asset raising this year is probably about the same as 2019. But the top 6 firms just got 22% new money in the 12 months to June versus the traditional firms just 1%. I mean, they're really breaking ahead.
Because after the pandemic, it was this kind of free-for-all feeling of like everyone's trying to start a private credit firm. Is that just done? Is it the big are going to get bigger? If you're a small firm or even want to start a firm, it's just not possible in today's environment.
Oh, look, from my conversations, and also with the traditional firms who are trying to, let's be clear, get into this, there's a lot of firms who've got the for sale sign up. Not at the top end, but there's ones who go, well, they either need to source assets or they need to originate assets, both of which are tricky because of what the dynamics at the moment. So no, I think there's a hollowing out of the middle.
So there's no peak in private credit. How much more does it really have room to grow?
Well, look, there was this cheeky comment about the golden period. In 2023, the banks were on the back foot. As last time I was here, we chatted about the private credit took 90% share of LBO financing in 2023. The banks are back in business. They've taken back about half the share. But what's really interesting is different banks. I mean, it's the really big ones who are squeezing. No, I think there's more runways. I mean, the way I think about it is that we've had wave after wave after wave of disintermediation in US banks. I mean, bank lending as a share of the economy peaked in 1973. It's a long while ago. And so I think the next wave is around asset-backed lending, about real estate, and a bit of infrastructure. And so actually it's more about moving into slightly different asset classes rather than just LBOs and direct lending.
Let's spend some time on that. Let's talk about the future of banking. To hear what you just said, that bank lending as a percentage of the overall economy peaked back in the 70s, might be news to a lot of people. We had a guest come on the programme a few months ago, and I often get this guest from KBW to go over the same stat again and again and again. Just how many banks are actually in the mortgage lending business, how they've retrenched over the last 10 years. If banks aren't in the money lending business anymore, what are they in? What are they doing? What's the future of bank lending?
Well, look, there's a huge variety. I mean, let's be clear, it's the larger one. And at the end of the day, banking was there to try and help payments and store your money. They're still doing that, obviously, and the crypto boom and has not meant that people are not moving their money out there. So I still think there's a lot of payments and managing your things. So security services, prime brokerage and so forth, there's still a fair degree of lending for investment-grade assets. So, let's be clear. But I think, let's say, if you're looking at the banks, the bottom line is, if you're lower margin, you need more scale. So I think it's really interesting whether it's the UniCredit deal announced, whether it's been the flurry of US deals in the 2 years before. It's about how do you get more scale? And that's the challenge I think my conversations with banks are having about.
How difficult is it to get scale in Europe?
Oh,
you brought up that
brutal.
deal. How hard is that going to be?
Yeah, I mean, it's such a... Well, look, I wish Andrea best of luck on this, but it's tough. There's been, one cross-border deal in the last 5 years? I mean, it's really been
What's difficult about it? Is it a cultural thing? What is it? What's holding it up?
All sorts of things. A lot of it's... So think about it. If at the end of the day, the purpose of a bank is to hold deposits and help you pay, then you want a great deposit guarantee scheme. And let's be clear, even here, basically you had to sort of verbally guarantee all deposits, 18 months ago. So we have a fragmented quilt of deposit guarantee schemes. In fact, in Germany, you have 3 different schemes. You don't even have one for the country. So you can't get cross-border. But, on the positive side, just take the UK where I live, we've got 3 deals at the moment, which are live, of in-market consolidation. So it's happening. It's just probably not on your show because it's not sort of absolutely top of the news list.
One of the other things that the banks are trying to do to keep up is in their asset management divisions, have their own private credit. Goldman is a great example of this, a monster $20 billion fundraise for them. It is more competition in the industry. What does that mean in terms of covenants getting lighter, of giving more favorable terms, of maybe some of that risk of too generous of terms creeping into deals?
Oh, look, everyone wants to get into private assets one way or another with partnerships. And one stat we put out in a report yesterday, which comes back to conversations we've had, is if you take all the listed asset managers in Canada and US, 64% of the value is now the alternatives. Dial it back to 2010, it was 4%. I mean, they are dominating. And so it's kind of, if you can't beat them, join them. And so actually, I don't think you've had on much, but I think one of the most interesting discussions is not so much is X buying Y, but the partnerships. So whether it's Partners Group with BlackRock or KKR with Capital International or Apollo with State Street, these kind of maybe not all of them will work, but at the investment frontier is these hybrid products and trying to work out which one's going to work to get into sort of a mass affluent hand. And so if you go back to what the traditional firms are doing, they're all thinking, who do I partner up with if I can't do it myself?
Hugh, you're the best. It's always good to catch up with you, sir. Thanks for your time.
Thanks
Appreciate it. Hugh Van Steenis there of Oliver Wyman. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Yahara Hackers. Hey, Yahara.
Hi, John. Alphabet shares are falling about 1% in the pre-market as the U.S. Justice Department considers breaking up Google. The agency saying in a court filing it's considering options to mitigate the tech giant's dominance in search. The judge could also order Google to provide access to the data it uses to build its search results and artificial intelligence products. Google has already said it plans to appeal the ruling. Meanwhile, Bloomberg reporting Couche-Tard sent Seven & I a fresh offer worth $47 billion. The Canadian company is still trying to take over the Japanese retailer after its initial bid was rejected, but no new negotiations have taken place. The latest offer represents a 20% premium from the prior offer and Seven & I's closing price yesterday. Meanwhile, Boeing shares are falling in the pre-market. The company withdrew its contract offer to workers as talks with the International Association of Machinists and Aerospace Workers Union broke down. Both Boeing and the union blaming each other for the impasse. S&P Global Ratings warned it may cut Boeing's credit rating to junk as the strike nears the 1 month mark and its cash struggles pile up. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the programme, Hurricane Milton closing in.
It could be catastrophic, especially around the Tampa Bay area, down south to around Venice, where we could see as much as 15 to 20 feet of storm surge just south of where the storm makes landfall.
That conversation up next, live from New York City. You're watching Bloomberg TV. Stocks just about unchanged on the S&P 500. We're negative by 0.05%. In the bond market, a lift. Yields up by 2 basis points, 4.03%. Under surveillance this morning, Hurricane Milton closing in.
It could be catastrophic, especially around the Tampa Bay area, down south to around Venice, where we could see as much as 15 to 20 feet of storm surge just south of where the storm makes landfall. You could have multiple high tide cycles of storm surge coming in. And then, since we had Helene, a lot of these bays and inlets, the barrier islands, have been significantly weakened by Helene.
So here's the latest. FEMA bracing for Milton's landfall. Already stretched thin following Hurricane Helene, the agency is preparing for a $3 billion deficit by February. But the government says it has the resources to meet immediate needs. The former FEMA administrator, Craig Fugate, joins us now. He led the agency under the Obama administration. Craig, thank you for giving us your time this morning. We recall also some of the work that you did with Governor Jeb Bush back in the early 2000s, and maybe we can start the conversation there. Of the hurricane seasons that you oversaw in 2004, 5, 6, when you think back to that period, what's different about the hurricane seasons now that we have to confront in Florida?
Well, I think we're just seeing rapid intensification that we haven't seen before in history. So when you look at going back just 10 years, how many storms went from a tropical system to a Category 5 hurricane in less than a couple of days? And so, you know, I think we're having to just get ready for these more intense hurricanes as they're approaching and maybe not have the lead time. The good thing about Milton is there's been a lot of time to get ready. In fact, many people started evacuating as early as Sunday. So this is a little bit different than a storm that just popped up. They had time to get ready, but it will not reduce the impacts.
Craig, let's talk about the FEMA response. Are they prepared?
Yeah, I get this question a lot. And as bad as Helene was, FEMA has a lot more resources, a lot more capability. And they're not going to have to stop the response in Hurricane Helene. That's, I think, a big concern for people in that area, that while the national media has focused now on what Milton's about to do, FEMA is still working and supporting the governors in the states that have already been hit. And again, the priority in any of these disasters will be always life-saving, life-sustaining, and getting communities stabilized to set the stage for long-term recovery.
FEMA recently said, though, that they have only 9% left of their personnel reserves. That's about 1,200 people. Where do they look then in terms of getting the bodies they need to go to these areas that are going to be hit?
Well, those numbers really refer to staffing required for long-term recovery. The initial response teams reset between disasters. FEMA has a lot of capability to reprioritize their resources, as well as deploy people from the headquarters. We did this in Superstorm Sandy. If FEMA needs to, and given the size and impact of what Milton looks to do, I would imagine there's going to be a lot of people redeployed across the nation to support the state of Florida.
Is the current funding enough, or do you think Congress is going to be forced back into session and get off the campaign trails?
Well, right now, FEMA does have money to do the initial response and provide support to the survivors. I think the bigger question is going to be the level of funding required for long-term recovery, the permanent work, and that's not just going to be FEMA. There'll be a lot of federal agencies that will need additional funding to support the recoveries from these previous storms and disasters, as well as what we're about to see with Hurricane Milton.
And it's not even just those storms, Craig. Before it was wildfires out west that also required FEMA money. So you get to this point, as John mentioned, a $3 billion deficit. Does there need to be a structural change with FEMA and its funding to ensure that it can continue to deal with successive climate issues?
Well, this was a situation we actually faced it in the Obama administration, and then Speaker Ryan and at that time OMB Director Jack Lew had come up with a way to increase FEMA's funding, but it was always based upon the past storms, the past disasters. So the problem is, as we get bigger and more intense disasters with little break between them, we really need to look at a funding mechanism going forward. But I think it's critical we understand this is your federal tax dollars. This is increasing cost to the budget that does not seem to be slowing down. It's growing rapidly, and it's far beyond just what FEMA programs are being taxed with. So for the federal taxpayer, we're seeing a tremendous transfer of risk to the taxpayer, where previously insurance covered this. And as the insurance markets are no longer able to provide affordable or available insurance due to these increasing impacts, we're seeing this transfer of risk to the taxpayer. And that's going to grow. And I don't know if we have answers for that yet.
What does that mean, Craig, for when these areas get rebuilt that are still under risk? A place like Tampa also had impact from Helene, now again Milton. When government agencies, when FEMA, when others go in to rebuild these areas, does it need to look different this time because they are under constant threat?
The answer is yes, and FEMA has for a long time been focused on rebuilding better, not just putting things back. But the challenge is we're going to have to not only just put it back better, we're going to have to build it for the future risk. And that isn't going to be inexpensive. The other problem I see is that we're going to increasingly see a transfer of risk to government-run programs like the Citizens Insurance Program in Florida, because commercial insurance is finding it extremely difficult to be able to stay in these markets where it's an affordable product, given their extreme exposures.
It's a conversation we had earlier this morning, just devastating. Craig, appreciate your time this morning. Thank you, sir. Craig Fugate there, the former FEMA administrator. Look, it's easier, relatively speaking, to protect vulnerable parts of the country that have to confront issues like this one. What's been difficult about the last month or so is the damage done by Hurricane Helene in parts where you would think were untouchable, to the kind of pictures that we saw over the last few weeks.
And it's in these really rural areas, like in North Carolina, that it's difficult to get resources out to, that it's difficult to restore them with internet, let alone basic services. And this is why you get these calls of more needs to happen with FEMA. They need more resources because this is only going to continue to happen.
Coming up next on this programme, in the third hour of Bloomberg Surveillance, we'll catch up with Cameron Dawson of Newedge Wealth. We'll speak to Geetha Raghunathan of Bloomberg Intelligence on what it means for the Walt Disney Company. Tiffany Wilding of Pimco looking ahead to CPI in America tomorrow morning. And we'll catch up with Lynam of BlackRock. Your equity market just about unchanged on the S&P 500. From New York, this is Bloomberg.
To think that we could slip into a soft landing or a potentially harder landing is not unreasonable.
We look at it as a soft landing as we're already in the midst of it.
The problem with soft landing is it sort of would suggest that things have stopped.
It might not be landing at all and actually seeing the plane turning back up.
The economy is fundamentally sound, so it can absorb shocks.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
This narrative so far this year just going back and forth, back and forth, back and forth. Ian Lincoln of BMO with this to say, it is not difficult to envision a more modest round of job gains. Once again, undermining the narrative of a resilient employment landscape, going on to say, when combined with this week's inflation series, investors should be wary of yet another swing in the pendulum of policy sentiment. Equity futures right now in the S&P 500 look a little something like this. 90 minutes out from the opening bow, down 0.1% on the S&P. On the Nasdaq 100, we're down by 0.2%. Going into tomorrow, 8:30 Eastern Time. CPI, the main event for the data so far this week. Before we get to CPI 8:30 tomorrow, some Fed minutes a little bit later this afternoon. Still some queries about what happened to that meeting. Was it Chairman Powell just forcing everyone to go 50.
It will be interesting to see if the Fed minutes reflect any of that, but I'm also interested to see how it's kind of massaged. We know editors can kind of change what's put in the minutes, and considering we've had this jobs report, are they going to be changed to look in a more hawkish light? Are we about to see a discussion that basically takes 50 off the table from here on out and really broadcasts something that says the economy is strong, we don't need to cut as forcefully, and again, you get a hawkish narrative that comes back in and maybe yields go even higher?
I think Williams almost basically said it's going to be 25 from here on out. I'm actually interested in the minutes, even though they're boring and they're backward looking. How many individuals on that committee actually maybe preferred 25 and didn't go with it because they got this pressure from Powell himself, which many people have been speculating because of what happened in terms of potentially the leak or non-leak to the Wall Street Journal and the Financial Times?
Very few of them willing to sort of acknowledge that openly in public, at least so far in the Fed speak that we've seen. A couple of names to look at in the pre-market. One is Alphabet. It's down by about 1 full percentage point. We've talked about the DOJ's concerns with that particular company. Another stock to watch on a 5-day winning streak coming into today was Nvidia. Nvidia's up by another 0.7% in the pre-market. So the run continues. Look out for that name going into the opening bell a little bit later. Coming up this hour, here's the lineup for you. We'll catch up with Cameron Dawson of Newedge Wealth as tech whiplash hits markets. Geetha Raghunathan of Bloomberg Intelligence on Hurricane Milton's impact on Disney. And Tiffany Wilding of Pimco ahead of this week's inflation data. We begin this hour with tech stocks whiplashing global markets as traders attempt to look ahead to Thursday's inflation data. Cameron Dawson of Newedge Wealth saying we would not be surprised to see continued volatility in the near term as risk assets are going into this historically high volatility month priced for perfection. The volatility is unlikely to be cataclysmic given the backdrop of strong economic growth and a shift to more supportive monetary policy. With a very long word, Cameron Dawson joins us now for more. Easy to write than say out loud, Cameron. Thanks for that.
I put it in just for you.
Thank you very much. Let's talk about this run we've seen in some of these individual names. Nvidia's had a massive run, 5 days of gains. And for some people, they're reflecting on the first half of this year where we had this big boost in inflation. Turned out to be a bit of a head fake. We started to think about high rates for longer and tech stocks really started to perform. Are we reaching for that playbook all over again?
It is interesting to see the equal weight S&P 500, which has been doing better over the last couple of months, start to roll over on a relative basis, which just suggests that maybe there's this narrowness creeping back into the market. And you see it within the tech sector itself. Look at Nvidia being strong, driving semiconductors, but flip the page to software. Microsoft is breaking down. It's now below its 200-day moving average. So even within the all great tech sector, there are pockets of weakness being held up by just a couple of names.
Is this all about rate cut expectations? Is that in the driving seat or is it something else?
We think it's the confluence of everything. If you take a step back and appreciate the fact that you have strong economic growth, look at Atlanta Fed GDP now at 3.2%, supported by fiscal deficits as if we're in a crisis, now with the bond market pricing in the largest non-recessionary cutting cycle in 40 years, what is rate or what are risk assets not to like? And we think that's why you see credit spreads so tight. The BAA credit spread is now 100 basis points, nearly at the lows that we saw in 2021. Equity valuations 21.5 times. That's at nearly the highs we saw in 2021. So these markets are priced for perfection, but that's because the backdrop is quite nearly perfect. The question is, can it last and where does it go from here?
Does earnings season help with expectations of under 5% growth year over year? That's relative to what we've seen before, kind of a low bar.
It is a low bar because you've also seen those estimates get trimmed going into this earnings season, so maybe we can jump over this lowered bar. The thing that's interesting is over the last 2 months, you've actually seen 2025 estimates get trimmed as well. We think that's why markets have stalled out over the last couple of months. They've been relatively flat. So you do need to see earnings estimates continue to rise, we think, in order to support the market. The one thing that has been the key underlying support for this market since the beginning of 2022 is rising 12-month forward earnings estimates. That is absolutely critical to maintain.
And you've seen that in 72% of the companies, that's according to Bank of America, are expected to grow their EPS. That's some good breadth. But as John was just describing, the market doesn't have breadth at this very moment. Do you expect that to change?
It's certainly the hope of a lot of people. And if you look into next year's earnings estimates for 2025, the market has priced in the Mag 7 decelerating materially and the rest of the market accelerating in their earnings growth. But in a way that actually creates a high bar for the rest of the market to deliver because you have these big accelerations in earnings growth, which are already priced in and forecasted.
So the banks report on Friday, and we're all reflecting on what we heard maybe 2 weeks ago, when we heard from Ally Financial warn about credit risk, and we heard from Dan Pinto of JP Morgan, who talked about lower interest rates maybe weighing on net interest income. What do you think is going to be the standout theme for this reporting season for some of the banks, both big and small?
I think it all comes back to the credit risk question, which is the underlying question that we've all been asking. Is the economic data overstating the strength of this economy? And the message from the banks will be important because they'll give us a notion about small businesses, they'll give us a notion about consumers. And if we continue to see credit risks bubble up, look at default rates within consumers. That's what Ally was flagging back a couple of weeks ago. If you continue to see that, it would question some of this headline data necessarily not being as strong as maybe it looks on the surface.
In the weeds a little bit, Jack Caffrey at JP Morgan mentioned this yesterday. It's very unusual to see defaults on auto loans. If you go back to GFC, I remember all the stories we'd tell. The car was the last thing. It was the one thing you held on to. You always made that payment. What could that be about?
It's partially a function of the price increases that we saw coming out of the pandemic. It's partially a function of people reaching for cars coming out of the pandemic. But it also likely reflects the true K-shaped economy. It's usually the lower income consumer that's more likely to finance their cars and have floating rate debt overall with credit cards. We do know that the low income consumer is under pressure. And the one thing that is keeping them above water is this jobs market. It's pretty incredible that you're seeing this huge uptick in defaults with a relatively robust jobs market. Look at where the unemployment rate is. If that goes up any higher, this could actually have defaults in that cohort of consumers that would be in line with the GFC, even though consensus seems to be that we're not going to have a consumer-led kind of recession this cycle. So I think it is incredibly unique, but it is certainly something that catches our eye that makes us question the data.
That is one of those things, again, just out of line with an economy that's been driven by consumer spending. You also see it in some of these companies. In just the past month, Pepsi, Constellation, Nike, FedEx, RH, Hormel, Dollar Tree, Lululemon have all cut their sales or earnings. Again, just in the past month. Is there a sector, because this has continued to be a problem for this equity market, of staples, of packaged food companies that you just can't buy until we figure out what's happening with the consumer?
I think it's all a reflection of this fading pricing power, and that comes squarely to head with what we're seeing within forecasts for earnings, because earnings are forecasted to actually accelerate next year on the revenue line. If you see fading pricing power, companies effectively saying, we want to raise prices, but consumers are pushing back because they can't take it anymore, that suggests that you'll actually see a deceleration in revenue next year, which is certainly not what's being priced in.
Does that cap just how bullish you can be on an overall equity market, which with otherwise has good fundamental growth in the economy behind it?
We don't think it would be the end of the world or a too reaching of a base case to expect relatively flat returns in 2025. It's not enough to say, get out of your equities and run for the hills. It's just to appreciate that if that 12-month forward earnings number starts to flatline, it's likely that returns flatline. It looks a lot more like a year like 2015 or 2018, where the market chops sideways. And the good news in that is it effectively allowed you to grow into very fulsome valuation multiples, which is where we are today.
Cameron, I hate to be the Debbie Downer, but what if tariff man comes back? What if forward earnings actually look like for these companies?
We didn't necessarily see it impact company earnings in a material way in 2018 because it was far more pocketed. If we have broad tariffs, though, this is certainly something that could challenge the earnings picture because we do know it's effectively a regressive tax. We do know it does lower consumption. It's less of an inflation risk and more of the fact that it would dampen consumption, which then, of course, would cause you to question earnings estimates, and that would be a source of volatility for equities.
I meant to the Debbie Downer on the earnings estimates. Do you think companies are going to have to focus on this in this quarter because it is just around the block in terms of what this election is going to look like?
We've already been hearing from companies over the last, let's call it 3-4 months, that they've been delaying some capital spending. They've been delaying some hiring decisions because of election uncertainty. So certainly that is something that's weighing on their mind, whether or not they're going to absolutely make changes because of the election going into this earnings season. They'll probably say we have to wait and see.
Think about how wide the range is for 2025. A sweep for either side. We could have a corporate tax rate of, 28% on the one side and 15% on the other with conditions. What does that look like for you? Just how wide is the range for 2025?
Completely massive. And I think that what we have to appreciate is that both sides, what they have in common is that they're talking about higher deficit spending and growth dampening policies. So on one side, you get growth dampening from tariffs and potential immigration. The other side, you get potential growth dampening on higher corporate taxes, which just means that we then have to turn our minds to the bond market. And how does the bond market digest all of this? We do know that the bond market did not like the higher Treasury issuance in the third quarter of 2023. Treasury yields went up by 150 basis points, and valuations within the equity market hated it. So we do think that instead of this idea of buy the rumor, sell the news with the election, that the election itself could be a source of volatility if it results in a sweep.
That could be cataclysmic. Cameron, thank you. Did I do that right?
You got
I think
it,
I did.
yeah.
Thank you. All right, second go. Cameron Dawson of Newedge Wealth. Cameron, thank you very much. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira Hackers. Hey, Yahira.
Hi, John. Millions in Florida are bracing for Hurricane Milton. The storm was just downgraded to a Category 4 and is expected to make landfall very early tomorrow morning. Forecasters are anticipating the storm will deal a serious blow to the Tampa Bay area. Milton has sustained winds of 160 miles per hour, strong enough to tear homes apart, and a storm surge capable of dangerous flooding in some coastal cities. Meanwhile, General Motors is working to lower the cost of its electric vehicles. During an investor presentation yesterday, the Detroit-based automaker hinted at a new lower-cost electric pickup truck with a 350-mile range. GM's vice president shared that the company is also working to secure a supply of lithium iron phosphate batteries in North America, a move that will help lower EV production costs. And a new documentary about the origins of Bitcoin may have uncovered the mystery of who created the cryptocurrency. The HBO film titled Money Electric points to Canadian software developer Peter Todd as the man behind the alias Satoshi Nakamoto. The documentary's creator uncovered early posts on Bitcoin forums to track down the creator's identity. However, Todd shrugged off the idea and called the suggestion ludicrous. Nakamoto is believed to hold around 1 million Bitcoin, worth over $62 billion at current prices. That's your Bloomberg Brief. John?
Okay. Thank you, Yahira. Can you imagine how, I would just say that would just be the boring end to a movie just to find out his name was Peter.
Peter Todd, like the most basic
Nothing
of
wrong
names.
with the name Peter.
No, nothing wrong with it at all.
But Peter's out there, nothing wrong with that.
But it's like every, couple months there's like a new inventor that someone has found. They always deny it, and it's just another one.
I'll just find this guy on an island somewhere, billionaire, living it up.
He was a professor at McGill. He's way too wholesome to be the creator of Bitcoin.
Who knows? Up next on the programme, the Morning Calls Plus, Geetha Raghunathan of Bloomberg Intelligence on Hurricane Milton's impact on the Walt Disney Company. That stock's down a third of 1%. That conversation just around the corner. A little more than 1 hour away from the opening bell, equity futures just about unchanged on the S&P 500. No drama here. Yields pushing higher again, higher by 3 basis points on a 10-year, 4.04%. As crude turns higher by 1/10 of 1%. The relationship between those two things over the last few days, Danny, pretty well established. The moves in yields, the moves in oil.
And it's interesting because they've been based on different things. To start the week, it was geopolitical concerns, and the end of last week, too. Yesterday, it was China moving things. But how much will it really impact? To what level does oil need to be that inflation is a concern? Bank of America says that for every 10% rise in oil prices, it's 7 percentage points to core inflation. In other words, oil needs to get above $100 for there to actually be an impact. So they say we're not there yet.
WTI 73.60. Let's get you some morning calls. First up, Jefferies upgrading Southwest to hold, saying management is taking the right steps. That stock is up by 1%. Your second call from Loop Capital upgrading Home Depot to buy, expecting higher demand due to the impact of hurricanes. That stock is up by 1.3% in the pre-market. And finally, Goldman Sachs keeping a buy rating on Disney, noting Hurricane Milton could cause losses of $150 to $200 million for the parks division. That stock is down by a third of 1%. Sticking with the Walt Disney Company, the company closing its Florida theme parks in phases starting at 1 p.m. Eastern today. SeaWorld and Universal Studios also planning to close as Hurricane Milton barrels towards Florida. Geetha Raghunathan of Bloomberg Intelligence joins us now for more. Geetha, let's start with the Walt Disney Company. What steps are they taking as Hurricane Milton heads to Florida?
Yeah, so they are, as you just pointed out, John, closing the parks. And they've done this typically whenever we've had, Category 4, Category 5 hurricanes. The most recent one that comes to mind is, Hurricane Ian in 2022, and then you had Irma in 2017. Obviously, they take the utmost precaution in terms of closing their parks, but this does have a huge, economic impact for, of course, the whole economy and definitely for the Walt Disney Company.
As Goldman indicated, if you go back to Irma, it wasn't just the parks closed for a couple of days. It was also multiple cruise itinerary cancellations as well. Geetha, given the strength of Hurricane Milton currently, how are you thinking about the damage done, the consequences outside of the theme parks, and what kind of duration are you thinking about?
Yeah, so they had a Disney Wish cruise line that was set to sail on October 11th, which they've canceled. They've rerouted some of their other cruise ships. But yes, it does have very, very wide-ranging implications, John. So we ran some numbers too. We think, of course, that the minimum damage that Disney will see in its fiscal first quarter operating income for the park segment is going to be at least about $125 million. It will have impact, of course, on the cruise ships. And remember, Disney is already battling softness, a softer demand at its theme parks. We've seen kind of attendance been a little bit flattish. We think now it'll be down, maybe almost low to mid single digits for the current quarter. So it's definitely going to have a prolonged impact. And then remember, as we get into 2025 and maybe attendance starts to recover a little bit, but Disney is going to have the additional problem of a new Universal park that is going to open in Orlando. So we're seeing some prolonged impact for Disney, not just from the hurricane, but from overall theme park softness and competition.
Why then, Geetha, is Disney saying today that they're going to raise prices in Disneyland in California by about 6% on the most popular days? Do they even have that pricing power right now?
They do. So if you just kind of look at the parks business, parks is now the bread and butter of the Walt Disney Company. So even as, maybe just about 4 or 5 years ago, parks made up only about 35 to 40% of profit. Last year, it was almost 65% of profit. In fiscal 2024, it'll be about 60 to 62% of profit. So it is becoming a bigger and bigger portion of the profit pie as the linear networks are in secular decline and streaming is yet to really turn a significant profit. So parks are definitely important. And as they kind of see the slower demand, they have to kind of offset some of that slower demand by raising prices. The problem and the tricky part for them is they shouldn't price themselves out. Of course, I do think that they do have pricing power. They are undertaking this huge expansion across all of their properties, including Disneyland in California, which kind of, allows them to add attractions and allows them to, I think, charge a little bit more, especially with dynamic pricing.
You did mention, though, that they're going to face competition from Universal. And then, Geetha, you add in the cost of this hurricane. And then you add in people potentially being slow to go back to Florida, to go to places like Disneyland, Orlando. How do you see margins evolving over the time period?
So margins actually for the domestic parks business has been extremely strong. And this was a host of different things that they instituted through the pandemic. As the parks were shut, there were so many operational efficiencies that they kind of put in place. And we saw margins kind of go from, the high teens to almost the mid 20s and kind of inching their way even to, the high 20s. And, of course, we think that this is going to have a little bit of an adverse impact, just the overall theme park softness. Of course, you have the hurricane. But I think over time, we're definitely going to, the parks business has always been a resilient business. And I think over time, it'll definitely trend towards, the low 30s.
Over time, it's been resilient, but the CFO was talking about in August that actually it was a little bit softer. And he told us on Bloomberg TV that they were waiting for people to maybe stop going to Europe for their holidays and look more domestically. What is the cadence right now of people wanting to get out and that appetite to actually go to these theme parks?
Yeah, the appetite really has not been there. So, the way that they kind of characterized the situation was that the lower income customer or the lower income consumer is actually facing a lot of financial stress. Theme park prices, of course, have risen almost 35% over the past 7 to 8 years. So, yeah, they're definitely feeling that inflation. And then the higher income consumer, of course, traveling internationally. So that will continue to, I think, be a problem through most of 2025. And which is why we're kind of definitely going to see some amount of park softness. And we think there'll almost be $1 billion of an EBIT hit to the parks over the course of fiscal 2025 just because of that theme park softness.
Keith, I've got to squeeze this in every time we talk about this company. Have we found a new CEO yet?
Not yet. But they are searching. And, you have, of course, the front runner. I think the 4 internal candidates, the heads of, the park, the TV business, the film studio, and, of course, Jimmy Pitaro. Dana Walden looks like she's the front runner. But again, too soon to say.
They should just make a movie about this one. Geetha, thank you. Geetha Raghunathan, Bloomberg Intelligence. It'd be a very long movie. Been going on a very, very long time. Let's get you an update from the National Hurricane Center. This is the latest, all subject to change. We understand the hurricane has weakened to a Category 4 hurricane on a 5-level scale. The latest update came about 24 minutes ago from the National Hurricane Center. They said Hurricane Milton was moving northeast at 16 miles per hour. I can share this quote with you. Winds will begin to increase along the west coast of Florida by this afternoon. Preparations, including evacuation, if told to do so, should be rushed to completion this morning. This really is, Danny, a final warning.
It is a final warning. Again, after we already heard from the Tampa mayor saying if you choose to stay in one of these evacuation areas, you are going to die. Officials there saying roads saw in 150% of normal traffic on Monday. So it does seem that people are heeding these warnings, that they are getting out. Just their ease and ability to do so is the question.
Also, Palm Beach County now issuing a mandatory evacuation order this morning. So basically, some of these counties that actually weren't in the path, they're now saying better be safe. This could move. What we heard from the weather correspondent earlier, this could move path. So they want people to be safe first and foremost.
AccuWeather speaking to us a little bit earlier this morning, suggesting that we'd see landfall at about 2 a.m. a little bit later on overnight this Wednesday night. The National Hurricane Center, that's the latest from them in an advisory from about 25 minutes ago. Up next on this program, Tiffany Wilding of Pimco and Amanda Lynam of BlackRock as we count you down to CPI data in America. That CPI data 24 hours and 5 minutes away. We'll bring you a preview in just a moment. Equity futures on the S&P 500 as we count you down to the opening bell in about an hour and 5 minutes, negative by 0.06%, with yields pushing higher by another 3 basis points at 4.04%, and crude just about unchanged this morning on WTI 73.55 from New York City. This is Bloomberg. I forgot to say before we went to commercial break that Danny's gone on an assignment, so you're going to see a spare spot around the table. She's not run off. She's got an assignment, and you'll see her later on Bloomberg TV with a special guest. 1 hour away from the opening bell. Equities right now on the S&P 500, just about unchanged. On the Nasdaq, we're down by 0.1% after a big run for one particular tech stock, Nvidia. Let's get you some movers, some morning movers with Katie Grafford. Hey, Katie.
Hey, John. Well, as you know, the U.S. is weighing a breakup of Google, specifically the DOJ yesterday, saying in a court filing that the agency is considering asking a federal judge to force Google to break up and sell off parts of its business, rather. Needless to say, that would be historic. But the fact alone that it's being considered maybe is somewhat expected. Hence the muted reaction in shares right now, currently off about 0.5% an hour before the bell rings. But zooming out over the past 3 months, this obviously has been a weight on Google and Alphabet, currently down about 13% since July. Moving on, taking a look at shares of Boeing right now. Of course, that strike is barreling on. As you know, of course, production has been shut down on the West Coast for nearly a month now, and the news being that Boeing withdrawing its contract offer to its union. Making matters worse, you also had S&P Global Ratings coming out and saying that they're considering downgrading this company to junk. That's worth another 1.6% decline on Boeing. Let's end with some good news here. We do have NVIDIA, of course, the big leader in this market. It's up about 1.2% today. NVIDIA out with two pretty specific announcements, including a strategic partnership with Accenture. You also had Jensen Huang saying that the future of AI will be services that can reason. That sounds a little bit scary, but the stock seems to like it.
Katie, thank you. Appreciate it. Look out for Katie Shinelli and Matt Miller in about 30 minutes' time on Bloomberg TV. What a run on NVIDIA. 5 days of gains over that period. A move of more than 13%. We're talking about an additional $390 billion of market cap. As always, one to watch going into the opening bell. Your week ahead looks like this. At 8:30 Eastern Time tomorrow, we'll do jobless claims and CPI. Later on this afternoon, we've got some Fed minutes coming up. And then as the week progresses, it's all about Friday and bank earnings. JP Morgan and Wells Fargo just around the corner. With us to look ahead to that economic data, joining us now is Amanda Lynam of BlackRock. Amanda, good to see you.
Good morning. Thank you for having me.
Big questions about the payrolls report, the veracity of the data, the sustainability of the data, and whether it means this Fed's got to back away. When you think about what we could get from CPI tomorrow morning, how are you recalibrating your thoughts about what to expect from the Federal Reserve?
Right. So I think the way that we're thinking about it is that presuming that the inflation data comes in relatively in line, right? There's a pretty clear path for the Fed to cut, we think, to around maybe 3.5%, slightly higher in 2025. But then the conversations about the neutral rate of interest become that much more important. There's a lot of consternation in the market about, will we get as many cuts as were previously priced even a couple of weeks ago? For corporate credit, so long as those cuts are being reduced because growth is high, that's a backdrop that credit can easily absorb, and you're seeing that with credit spreads. What's been so notable to us, I would say maybe a couple of months ago when we would talk about revisiting the mid-2021 tights on credit spreads, we would get some pushback. Now the market conversation is, can we go even tighter than that? And that has been really telling. And we were talking about it all morning, above trend growth, Fed that is poised to cut, just determining how much. Those are good outcomes for credit.
It tells you about the bias of the market right
Yes,
now that
it
we're
does.
now asking how tight we could go on corporate credit spreads. Let's talk about the contradictions in the economic data. Last week, prime example, there was something for everyone in the economic data last week up until that blowout payrolls report. You could see it in consumer confidence. You could see it in the jobs data, the fact that hiring was down, the quits level had dropped. And then we have this blowout report. And the word that keeps coming up, contradictions. Yeah. Contradictions in the economic data. There's a word that I keep seeing in the work that you do, bifurcated. Does that explain the contradictions?
I think it does, because there is no one consumer. There is no one savings rate. Even looking at the economy, it's much more of a services-led economy than a manufacturing economy. So I think the mix shift of the economy is changing. The underlying kind of dynamics are different between whether it's consumer, commercial real estate, corporates. And then I also just think from the perspective of we're still unraveling some of these post-pandemic shifts. And so some of the old playbooks, the old economic rules, the inversion of the yield curve, the SOM rule, right? Those were pretty reliable recession indicators in cycles past, but I think there is a big question as to whether or not we can use those same kind of guardrails in assessing the economy today. And I think that's really what's underlying a lot of this.
John's been bringing up Ally Financial, which is a really good point. About a month ago, how they're talking about this intensification of what's going on, the credit challenges. Is that just for one side of the consumer?
Well, I think the subprime consumer is unquestionably under pressure because even as inflation is improving, they're still dealing with the higher price pressures. You had mentioned kind of that divergence between auto delinquencies and home price delinquencies or mortgage delinquencies in the economy today. I think one part of that is that consumers want to protect the value in their home. They've seen their home appreciate as a pretty significant asset, up, say, 55% using the Case-Shiller Index since 2019. So you want to protect that at all costs. So it does seem like the way that consumers are prioritizing debt payments has shifted across the asset types.
Can you take us inside the credit market then and talk to us about how well priced the story is that you describe? Of all these consumer-facing companies, if they are dependent on one cohort of consumers versus another. Are you seeing that discrepancy, that dispersion?
I will say the overarching theme in the corporate credit market is interest in laggards and whether or not they will catch up. And so I do think this is the point where we need to be discerning. For most of this year, triple Cs have lagged. Even retail was never really underperforming in the credit market, but you did see kind of that lower quality cohort of triple Cs lagging for most of the year. That underperformance gap has closed pretty substantially. Triple C spreads are now just above 600, which is slightly wider than where they should be given the high yield index level, but not materially so. So it seems to me corporate investors are kind of looking at the landscape. This is in IG and in high yield as well, and saying what has underperformed that I think is unwarranted, and can I step in? Now, the overarching headwind of the election hangs over that, especially if we get some meaningful impacts to tariffs. But I would say it's very much a risk-on tone in corporate credit. It's very much a what has underperformed that I think you might take the other side.
This is the second time that you've pointed to a really bullish bias in this corporate debt market.
Yes.
Is it uncomfortably bullish?
In certain instances, I think it can be, but I think importantly, we need to be respectful of the technicals, which, as you know, are so important in the corporate credit market. We've had very limited net supply. We've had significant demand from yield-based buyers. When we've had backups, they've been quickly bought. We're reinvesting higher coupons on an ongoing basis into this market, which is also absorbing that. And so we are very mindful of where are the fundamental risks, but I do think there's an opportunity cost to being underweight risk assets more broadly, and I think we have to be respectful of that. And within reason, we're treading pretty carefully.
Hearing you speak, hearing you talk about these issues, it begs the obvious question: why is the Federal Reserve reducing interest rates? Going into what you described.
Yeah, I mean, I think they've said as much that they don't know where the neutral rate of interest is. You know, that 3.5% that we're looking for next year is where we believe, pending additional information, where they can cut. There are pockets of weakness. Anne-Marie, you mentioned the subprime consumer. The leveraged loan default rate is approaching 7%. On an issue-weighted trailing 12-month basis. Still increasing. High-yield default rate has decreased. So in aggregate, credit has been resilient, but under the surface, there's a lot of bifurcation. No exception there. So I do think in order to stem the weakness that we've seen in certain cohorts, the Fed will continue to normalize, but we're not expecting easing. That's the real distinction for corporate credit, is normalizing.
You mentioned the election, this potential of tariffs. These things would unnerve investors. When do they start to price that in?
Right. So the way that we're approaching it is that the paths can be so binary that you want to be positioned so that you're not caught off sides either way. There are certain things that we expect to be prevalent no matter who wins. Higher deficits, some protectionist policies. The AI spend probably still continues. For that reason, we like financials, actually, because it's not subject to making a widget and shipping it across regions. It's not subject to the trade and tariffs. So I think there are ways that you can position around the corner. But I do think we just need to see what happens here and build in some nimbleness in portfolios, that you're not caught off sides either way, but that you can make some directional shifts. But we're seeing a little bit of volatility, I would say, around that. You were talking about it earlier this morning, but no major shifts to a large degree. I think it's just too close to call.
Big week for the financials, with the banks reporting on Friday, including JP Morgan and Wells Fargo. Let's get you the latest from Pimco. Here's a quote from them. The US economy, like others, appears poised to achieve a rare soft landing, moderating growth and inflation without recession. But there are risks, such as the upcoming US election, one, and its implications for tariffs, trade, fiscal policy, inflation and economic growth. Joining us now on their outlook is Tiffany Wilding of Pimco. Tiffany, welcome to the programme. Lots to work through with you. The economic data so far in the last week: payrolls on Friday, CPI tomorrow morning. How old are those numbers going to look by the time we've worked through the election and have a better picture of what 2025 looks like?
Yeah, so I think that's a really great point. We have an incredibly big election on the horizon here, with policies with either candidate that could look very different. Of course, the deficit, we think, is really the real loser here, with neither candidate likely to do anything about that or the longer term trajectory of government debt. But I do think that there are bigger differences within trade policy, and that will matter for markets. Trump obviously has former President Trump has been discussing policies that could be quite disruptive, just in terms of their scale and scope, if they're implemented the way that he's discussing. So I think that you have to be mindful of that type of risk, and as a result, you have to keep a pretty defensive portfolio.
Is this potentially the biggest risk to the soft landing, the U.S. election?
Yeah, I mean, certainly, when you look at the tariffs and the the aggressive nature with which he's talking about doing them, 60% on China, 10% everywhere else, there's a quote transition cost to that. The economy will have to transition to some new place after you implement those, and it would likely cause elevated recession, elevated inflation, the potential for recession. It would be a really tricky spot for the Federal Reserve as a result. And it just creates business uncertainty. So you don't have businesses that want to invest. You don't have consumers that want to buy durable goods, for example. And that's happening potentially on a global scale. So I think there's definitely some huge risks here around the election. Now, there's a question around if he and will he implement the things that he's talking about. Of course, President Trump obviously likes to look at the equity market as a barometer of his overall success. We can't imagine that the equity market would do well in that kind of scenario, so probably will temper him. But nevertheless, it's a risk that markets and portfolio managers have to deal with.
Maybe making quick U-turns on policy, depending on how the S&P 500 or, for the former president, the Dow Jones does on a specific day. You mentioned the deficit, fiscal policy. Both these individuals, vastly different corporate tax rates. What does that mean for the overall health trajectory of the U.S. deficit?
Yeah, well, really, the longer-term issues around the deficit, are less about these, more discretionary pieces that are being discussed. They're really about the non-discretionary programs and the trajectory of demographics in the United States. So, like Social Security, Medicare, and Medicaid. Neither candidate has said that they're going to touch either of these programs, and you really can't change that longer-term trajectory without doing so. So as we sort of suggested, this is really just, tinkering around the margin. We think they probably will come up with a plan. We have to, we're dealing with the Trump tax cuts, the Tax Cuts and Jobs Act extension. Most of those will probably be extended. Potentially there could be some pay-fors. Of course, the Harris side is talking about through higher corporate tax rates, while the Trump side is talking about raising money through tariffs. So, there certainly will be differences, but overall, we don't think it's going to make a huge dent in the longer-term trajectory of the U.S. debt.
Tiffany, we'd really appreciate your outlook as well on the upcoming information that we'll get off the back of the hurricane that's about to strike Florida. The incoming economic data might be very distorted, muddied by the hurricane that we've had before, Hurricane Helene, and the one we're about to get overnight, Hurricane Milton. The fact that in between some ports were shut as well. How are you and the team thinking about the incoming data over the next month or so off the back of those issues?
Yeah, well, certainly it's going to be noisy. The first issue is just that there is a reduction in activity, usually in the month when the hurricane hits. But then afterward, there is more rebuilding. We obviously, our hearts go out to the folks that will be impacted. But just from an economic perspective, you do tend to get a bit of a surge in activity after these kinds of events. Again, just because of that rebuilding. You also tend to just get more inflation. Used car inflation as you have an increased level of flooding that is resulting in replacement activity for cars tends to rise. So, it just tends to, create a kind of inflationary environment. And that's something that the Fed is going to have to watch. Now, we don't think that, the impacts will be like what we've seen over the past few years in terms of inflation. But it's certainly something that, could keep the Fed on edge, over the next several, quarter or so as we're kind of working through the effects of this in the economy.
On edge and not on pause, not on hold?
Yeah, well, our own view is that the Federal Reserve, a range of scenarios here, they can continue a sequence of rate cuts. And we compare their policy rates to, Taylor rules. Things, kind of normative rules of where policy can be. And they have a lot of room to cut interest rates here. So, they waited, they were delayed in cuts relative to what their own rules would have suggested. And now they have, more room. And we think as a result of that, they probably are embarking on a sequence of cuts, 25 basis point rate cuts. We think the recent data, by the way, has taken some downside risk out of that. But 25 basis point cuts at every meeting between now and, say, March before you slow down to try to figure out where the neutral rate is, seems reasonable to us. You see how the economy responds to that, and then you go from there.
Tiffany, you make it sound easy. It's good to catch up. Tiffany Welding there at Pimco. Appreciate the update. Amanda Lynam of BlackRock still around the table with us. Amanda, just a final word. Do you see it the same way as Tiffany? Are the cuts easy up until March?
I think barring some kind of extraneous events, yeah, I think they are. I think there's a pretty wide agreement that we're above neutral, but how far above neutral is really the question here, and I think that's really going to matter. But again, if we don't have as many cuts delivered because growth is supportive, that's an okay outcome for risk assets in our view.
Amanda Lynam of BlackRock, appreciate your time. It's good to see you this morning. Thank you. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Yahara Hackers. Hey, Yahara.
Hi, John. The Kremlin confirmed that former President Donald Trump sent Russian President Vladimir Putin COVID-19 testing devices during the height of the pandemic. The claims were first reported in a new book by Bob Woodward. As for another claim made in the book that the two leaders had spoken by phone several times since Trump left office, the Kremlin denied that one. Meanwhile, fewer people in the U.S. are applying for mortgages. Applications fell for the second week in a row last week. They were down by 5.1% from the week prior. This coming as U.S. mortgage rates jumped last week by the most since July 2023, putting an end to a months-long slide that was helping revive housing activity. The contract rate on a 30-year mortgage rose 22 basis points to 6.36%. And the Minnesota Lynx are heading to the WNBA Finals after an 88-77 Game 5 victory over the Connecticut Sun. Minnesota was led by Defensive Player of the Year Nafisa Collier, who had 4 blocks in addition to scoring 27 points. Minnesota will be looking to win its 5th championship in franchise history, which would be a league record. The best of 5 series against the New York Liberty begins tomorrow night in Brooklyn. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate your work this morning, as always. Wanted to fit in this as well. One of the biggest stories in this nation at the moment. All eyes will be on Florida as the state prepares for Hurricane Milton. Joining us now is ABC's Rena Roy from Tampa. Rena, walk us through the time you expect landfall, the intensity as this hurricane evolves, and how things are tracking currently.
Yeah, well, John, I can tell you that about 6 million people across 11 counties here in Florida are under mandatory evacuations. And you can see right behind me here that rain is coming down. It has gotten more consistent and heavy as the morning has gone on. We've also started to feel some gusts of wind as well. You asked about landfall. Well, that is expected to happen sometime tonight between 9 p.m. and midnight as a low-end Category 4 hurricane, bringing up to 18 inches of rain and a record storm surge of up to 15 feet in the Tampa Bay area. It is unclear where exactly landfall will be, but at last check, the path was veering slightly more south near Sarasota, and it is all hands on deck here. The governor says the National Guard storm mobilization is likely the largest in state history, with thousands of troops activated. And some areas are now actually extending evacuation orders further inland due to storm surge concerns there as well. John?
Earlier on this hour, Rena, we got an update from the National Hurricane Center. Came in at about 8 a.m. Eastern time on the category of the storm, dropping back from maybe a 5 to a 4. Could you walk us through the difference there and how small a change that might be?
Right. Well, when we talk about categories, we're talking about the wind per hour. And so right now it's kind of fluctuating between 3 and 4. It's unclear because things are going to keep changing throughout the day. We do know that this hurricane is getting larger and the wind field is widening. So we know that there was going to be some pretty widespread destruction here.
Rena Roy, I know you've got to go. Appreciate the update this morning. Thank you. And we'll catch up with you tomorrow, no doubt, as well. Stay safe. Rena Roy there of ABC. The latest on Hurricane Milton as it barrels towards Florida, expected to make landfall later on tonight at about 2 a.m. Eastern time, according to the latest from AccuWeather. Up next on this programme, we'll set you up for the day ahead, the trading diary, the calendar for the next few days from New York City. This is Bloomberg. 38 minutes away from the opening bell. Equity futures right now on the S&P 500, just a touch softer, as they have been all morning. No real drama, though. We're negative by 0.06% on the S&P, following a gain of almost 1 full percentage point in yesterday's session. Thank you, NVIDIA, for supporting this market. It's a Thanksgiving period coming up. Thank you, NVIDIA. You know what I'm talking about. A 5-day gain on the stock of more than 13%. Over those 5 days, we're talking about adding $390 billion to a single name. It's a ridiculous run, and it's up another 1% this morning on that stock in the pre-market. That's the story of the equity market so far. Switch on the board and get to the bond market. Earlier on in the last week, we had a 2-year and a 10-year breach 4% for the first time since August. We backed away at the front end of the curve. The move sticks at the long end. We're up another 2 basis points on a 10-year at 4.03%. The move in crude. Also, the first time since August, we saw a breach of $80 on Brent crude. Since then, we've backed away. We're down 0.6% on Brent crude, 76.72 on WTI, 73.14. AMH, things a little bit softer in the commodity market.
A little bit softer, but the next catalyst, there's two really, can be for the upside of prices. One, we're going to get this briefing from the Chinese finance minister talking about potentially more fiscal spending. That might increase this idea of more demand coming out of China. But then, of course, the geopolitics of all of this and this uncertainty about potentially what Israel's response is going to be. And if you potentially see any sort of inclination of a wider conflict, prices will spike again.
Let's just sit on that. We were expecting the defense minister to come from Israel to Washington, D.C. We were looking to see what would happen. There was a feeling that maybe an attack wasn't imminent. Where are we now?
Well, the defense minister is no longer coming, and Israeli officials basically said that Netanyahu is going to decide what to do and is going to get a phone call with President Biden today. They haven't spoken since August. I read this as the United States was trying to basically calm down Netanyahu or basically just buy time. The defense minister coming here means there's not going to be an imminent attack. Now, potentially, at least reading the tea leaves, maybe there would be something sooner, as in this week, in terms of that retaliation.
Commodities down across the board here. We mentioned energy pulling back. We're down by about 0.5% there on WTI and on Brent crude. You're seeing it in base metals. On copper in London, we're down 0.8%. Precious metals, similar move, just a little bit softer. We're down 0.1%. Amri alluded to this, the China piece of the puzzle. We'll get more on that over the weekend. Looking for an update on fiscal policy from Chinese authorities on Saturday. Look out for that briefing. As we count you down to the opening bow, the other things to look for through the next couple of days or so. Fed minutes coming at 2 p.m. Eastern this afternoon. Look out for that following that 50 basis point interest rate cut from the FOMC. This is the details of what happened in that meeting. Remember, they can massage some of this, so look out for that a little bit later this afternoon. Tomorrow, we'll get CPI and another round of jobless claims, plus Delta reporting earnings. On Friday, PPI and Newedge consumer sentiment. And a big one. Earnings season really ramps up. We'll hear from the major players of Wall Street, kicking things off with JP Morgan and with Wells Fargo. Look out for that on Friday morning. Coming up tomorrow to break down all of these themes and look ahead to that economic data, we'll catch up with Brian Levitt of Invesco. We'll speak to Dan Greenhouse of Solace Alternative Asset Management. Mike Wilson of Morgan Stanley earlier this week. Overweight consumer cyclicals. We'll break down that call with him tomorrow morning, and we'll speak to Erica Najarian of UBS on the upcoming bank reporting season. As we count you down to the opening bow, 35 minutes away. Equity futures on the S&P 500 just a little bit softer, basically unchanged. We're negative by 0.06%. And in the bond markets, as we said, repeated all morning, we hold on to that 4% yield on a 10-year yield, up by 2 basis points this morning. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.